That's a full house we have here. Good morning, ladies and gentlemen. I'm Lopamudra Ghatak, the lifestyle editor of the economictimes.com, and I take great pleasure in welcoming you to the third ETMarkets Global Summit, brought to you by AMC partner ICICI Prudential AMC, associate sponsor 5paisa.com, and our partners Faircent, BSE Brokers Forum, and our telecast partner ET Now. As most of you know, we are meeting here after a year, and what a year it has been. The past year has been a subdued economic climate playing out in the global theater that has led to some reduced consumer spending and muted sentiments. The trade war between the United States and China and a delayed Brexit decision have made headlines for the ramifications that they are likely to have in other parts of the world as well. Against the backdrop of such a global economic climate, we in India too have faced some turbulent headwinds that have precipitated fears of a slowdown. But despite a slump in some quarters, India remains resilient with its economic fundamentals and checks and balances in place. And as they say, tough times don't last, tough people do, and tough markets certainly do once they are able to withstand adverse conditions. For market watchers and analysts in India, the next few weeks and months remain very critical, and that brings us to the theme of the third ETMarkets Global Summit. How do you spot a window of opportunity in an uncertain economic and business climate? Have the old ways of value discovery failed in the new investment environment? Can a robust monetary policy alone drive economic growth? Over the next few hours, we will have the best minds from industry, investment domain, and government debate and discuss ways to revive the wheels of growth, trust, and investor confidence. We also have experts from the capital market ecosystem who will share the roadmap that needs to be charted in order to make India a $5 trillion economy. And now, ladies and gentlemen, it gives me great pleasure to introduce Mr. Deepak Ajwani, the editor of economictimes.com, India's largest and most read business news website. A business news veteran himself, Deepak will tell you why these turbulent times call for a complete rethink on our investment strategies and the best way to deal with debt in a post-IL&FS market. May I have you on stage, Deepak?
Thank you, Lopa. Good morning, everyone, and welcome to the third edition of ETMarkets Global Business Summit, #ETMGS. For us at ETMarkets.com, this is now becoming a good habit to come and meet all of you market champions and help gather some of the best insights from our industry wizards and all that matters for Indian and global investment opportunities. At the Economic Times, ET Markets is our flagship ET brand that manifests in not just print and digital mediums. We are now also present in 9 Indian languages with a dedicated mobile app for ETMarkets.com on both Android and iOS platform. At this third edition today, we have for you some of the sharpest brains from India and the world who will help us decode wealth-making mantra. During multiple sessions today, we will probe deeper on the issues that move or hit the Indian economy over the next years and learn how to navigate the turbulent times with a smart strategy. Right from questioning the age-old practices of investment to discovering newer ways of value buying, debating on the current monetary policy and its relevance as the economic engine growth, to probing the fundamentals of market technicals. We plan to make each and every single session not just relevant, but drive clear, actionable outcomes, because that's why you are here for. The $5 trillion economy goal that India has set for itself is indeed audacious. But how does it translate into market opportunities? How do you all and us make money together? And that is what we need to understand today. When and why will this magic happen? This is a question not up in the air. It's discussed right here, today itself, amongst all of you. And we will find out if it's a pipe dream or an achievable target. At ETMarkets.com, our agenda is pretty clear. Put the investor at the center of everything we do, and then work closely with market patrons like you and our readers on the website and apps, and understand, decode, and augment the process of wealth creation across the value chain. And that is what we will do today at this third edition of ETMGS.
Thank you, Deepak, for setting the agenda. That's right, make friends, make money, and make connections. And here we are kicking off the opening session with a question that's weighing on the minds of everyone assembled here. Are the old ways of value discovery failing in this new investment environment? And to answer that, may I request Mr. Nikunj Dalmia, Managing Editor, ET Now, on stage. Nikunj will be in conversation with Mr. Mark Mobius, the founder of Mobius Capital and an emerging markets guru. Mr. Mobius set up the Emerging Markets Group at Templeton and has managed it for over 2 decades. And here's letting in on a secret, he's also a die-hard Bollywood fan. And before I hand over the stage to Nikunj and Mark, do remember to tweet with the hashtag ETMGS and tag ETMarkets on Twitter. Over to you, Nikunj and Mark.
Thank you very much. Good morning, everyone. It's always a delight and a pleasure to be here. This one event I personally always look forward to. And with Mark in this room, I guess we all should look forward to Mark and interacting with him. You know, over the years I've interacted with him, the world has changed, but Mark Mobius still looks the same. He does not get old. Mark, may I invite you to just take the stage and then walk us through your presentation. Put our hands together for Mark Mobius. Thank you. The presentation is just prior to that. So you want to go ahead
So
with the
I do
presentation?
this sitting or standing?
Whatever is comfortable.
Okay, I'll
with you.
stand. I'll
Okay.
be here.
I'll also
Please
stand and see.
sit
Then. No,
down.
no, I'll have to stand
Okay.
and see. Come.
Thank you very much. By the way, it's amazing to me to hear that this newspaper, Economic Times, is published in 9 different languages. It's probably the only newspaper in the world that has that incredible impact. It's just amazing. And you know, one of the things I tell people when I talk about India is the incredible diversity of this country, which is wonderful. It really results in tremendous creativity, new ideas, and new concepts. It's just a wonderful thing. And Economic Times, I think, personifies this incredible creativity. So I really appreciate Economic Times inviting me today for this session. By the way, the earlier speaker said that you have the sharpest minds here today. I'm sorry to disappoint you, but I don't have a sharp mind. I have a very dull mind because I've been in the business too long, and it's just like when you're sharpening a knife, it gets dull eventually. You use it too much. But anyway, my task today in 15 minutes is to explain to you, or at least to give you some idea as to whether value investing is still working. Does it still make sense to use value investing? And it's a very challenging question for me because I was nurtured by John Templeton, who, as you know, was one of the big value investors way back starting in the 30s, 40s, 50s, all the way through, along with Warren Buffett and the others. And of course, I remember someone asking John Templeton, what is value investing? He said, value investing is when you buy low and sell high. Sounds easy. And I remember his saying, to buy when others are despondently selling, and to sell when others are greedily buying requires the greatest fortitude and pays the highest rewards. And there's a lot of truth to that statement. But there's another aspect of value investing, and that is earnings. How do earnings stack up along with the share price? Which is why I remember when we started on this journey, we used to always look at PE, price-earnings ratio. And then we moved on to price-to-book value. These were the key parameters. You know, EBITDA and all these other more sophisticated systems were not used in those days. So we used PE, price-to-book value, and dividend yield. But if you look at the history of these parameters, it's very confusing. And I just wanted to show you some examples of this with the S&P 500 and the emerging markets index. See if I can bring those up. You have those there? Okay. If you can bring those up, I'll bring that up in a minute. But in any case, if the charts I show you will show the incredible variability. Of course, prices are moving as well, but the incredible variability of these indicators at the end of the day really doesn't help you very much to consistently perform. And what we found over the years is that the most important overlooked variable has been the people behind the stock. Who is running the company? Who is the person actually making the decisions? And that was so often overlooked because you say, okay, this stock has got a low PE, it's got a low price to book value, it's got a high dividend yield, great, let's buy it. No, because very often you are finding that the company was not being run by very honest people or people that were not very capable, and then you were in trouble because the stock price crashed. And I know here in India you've had this experience just like in any other markets in the world. So what we've done now is begun to move on and say, okay, we can look at PE, price to book, dividend yield, that's fine, but we've got to pay more attention on the people behind the company. Because we want value, we've got to find value management and value ownership. And then we also began to discover that in order to move behind the numbers that can be manipulated, and as you know, earnings can easily be manipulated, and book value can also be manipulated depending on how you're valuing various parts of the assets of the company. But things like return on capital employed, return on assets, often cannot so easily be manipulated. So we're looking more and more at that value indicated. In other words, how much can a company earn in relation to what we think are the assets? That's number one. The other thing that cannot so easily be manipulated are the yields. In other words, the dividends. Because if you're combining the return on assets, return on capital employed, and dividend yield, you'll often see some interesting discrepancies. Because a company cannot pay out cash dividends consistently without having a good return on capital. So you'll often find a situation where the dividends are coming in very, very good, but the return on capital does not equal the dividend yield. Something is wrong. So this is where we can sort of look behind the traditional numbers, the traditional PE, price to book, etc., and look at really what's happening behind the scenes of a company. Of course, there's a lot of detective work, and I'm sure at these sessions that you have, you're going to be hearing more about that going forward. But these are the things we're beginning to look at when we talk about value. Now, the next question is, how can we talk about value when interest rates are zero or negative? And of course, that's the situation today. I was just talking to a gentleman, he said in Romania, the bonds are now running at negative interest rates. How do we value companies? And again, what I would say is that now is the time to start looking at dividend yield. Because if you're not getting anything in the bank, or if you're going to have to pay the bank for keeping your money, you better look at companies that have dividend yields where you can get some yield on your capital. And I believe going forward, you're going to see if the current situation remains where interest rates are low, very low, or negative, you're going to have a situation where dividend yield companies are going to do very, very well. And you'll see more and more of that going forward, I believe. So in sum, is value investing dead? Of course not. Because at the end of the day, earnings are what count. In other words, stock prices respond to companies that are earning. And of course, a lot of people will say, wait a minute, Amazon was losing money for a long time, and so was Google. Well, that's another problem when you're looking at value investing. A lot of people think, well, we'll look at the history of a company, but that's not enough. You've got to look to the forward history. In other words, what is going to happen in the future? And that's what people are buying. Basically, when they're buying a company, they're buying future earnings, which is why very often when we're looking at dividends, for example, we will look at companies that have steadily rising dividends. In other words, companies that are able to consistently increase their dividend yield as we go forward. So this combination of looking forward rather than looking through the rearview mirror, which, by the way, well, even now today, if you talk to any analyst, you ask him, how did you come up with this earnings growth number? He said, well, I looked at the last 3 years and they've been growing earnings, and so I projected forward. This is the only way a lot of people have been working. But now we have to do a lot more work in looking at the environment of a company, look at the management of a company, look at what their own plans are, and to see if we can get those rising earnings and rising dividends going forward. So in sum, I think we're in a very, very sweet spot, actually, in stock markets around the world because interest rates are so low. Equity investments, particularly equities that are in a dividend-paying mode, are going to do very well. But just to give you an example of what I was talking about, this shows you the S&P 500 price-to-book ratio. And you can see recently that ratio has been increasing. But the important thing to remember is that if you look at the S&P 500 index, it's been steadily rising. But look at this. Look at the way the price-to-book value average has been moving. And if you look at the emerging markets index price-to-book ratio, you can see, again, difference. S&P dividend yield, right now, the average is running about 2%. At one point in 2009, it was as high as 4%. If you look at the MSCI emerging markets dividend yield, we're now running at 3%. By the way, this is another reason why we believe that emerging markets are the place to be, because you're getting better earnings, and of course, as a result, you're getting better dividend yields. If we look at, finally, at the next, I'm sorry, there was a few other, there we are. This is the dividend yield, and after that, there was another, I believe, no, I'm sorry. Here it is. S&P 500 dividend yield, 2%, and the MSCI emerging markets was now at, this is the price-to-book ratio. That's the other one. This is the MSCI price-to-book. It's about 1.7. At one point, by the way, in 1999, you can see it was well below 1, and that was an incredible bargain hunting time. But this gives you some idea of the incredible variability of these ratios, and probably not a very good thing to rely on alone, as I mentioned. You've got to look at the management, you've got to look at many, many other factors. So, in summary, value investing is not dead. It's still alive and kicking. Thank you very much.
Mark, great presentation. I'm just going to first pick up the global mood. From Ray Dalio to Harvard Marx to just about every global guru. They've been saying, look, guys, this is the longest economic expansion US markets have seen. This is the biggest economic expansion after World War. It cannot be that good. It cannot be that true. And if the US economy sinks or slips or corrects, US markets would correct sharply. Do you think somewhere we need to be cognizant of the fact that world has not seen a sharpish equity correction after 2008?
I think what we're faced with now, and this has probably been taking place within the last 15 years, is that there's been an acceleration of productivity as a result of the digital revolution, as a result of the internet, result of the incredible increasing speeds of information flow. And this is one thing I think the central bankers have overlooked. You know, they're focusing on erroneous inflation numbers. The inflation numbers really are erroneous. I don't think they really reflect what's going on in the market. And the fact is that we are in a deflationary environment and have been for quite some time. So if the central bankers are trying to achieve this magic 2% inflation and pumping money into the system, you have an incredible flow of capital. And by the way, no one really knows what the money supply is because you've got all of these other currencies coming into play. So you have an incredible flow of funds going into investments, and that is driving increasing productivity gains as a result of this digital revolution. So we're in a new game, and that's the reason why I believe you've had this stock market boom in the US and continuing increase in the stock market gains.
Mark, to quote from where you started from, Sir John Templeton, buy when there is fear on the street, sell when there is greed on the street. If I look at the US market and including our markets right now, 20 stocks, that's it. 15 stocks, including FANG stocks in America, the Microsoft, the Apples, and the Amazon, that's about it. Why do you think there is so much of concentration in a select few stocks? At a time when cost of capital is low, some would imagine that it should be a broad-based market rally. But it's concentration, and concentration in very select few companies, businesses, or sectors.
The reason for that, I believe, is the rise of ETFs. You must remember now, in America, and I believe probably here in India, you're seeing the same phenomenon. ETFs are now overtaking actively managed funds. So what are ETFs? ETFs are index vehicles. And the index is driven by the largest stocks. So you have a situation where as the money comes into ETFs, more and more money goes into the indices, and that pushes up the largest stocks, because the largest stocks are what driving the index. So I believe that's what's happened. And by the way, this presents an opportunity, because since a lot of the money is chasing those big stocks, there are a lot of bargains to be had in the smaller stocks. Because don't forget, many of these smaller companies are now taking advantage of the digital revolution. In fact, one of the things we look at when we're examining a company is what is their digital philosophy? What is their plan to take advantage of the digital revolution? So I believe that this presents a big opportunity.
Before I talk about specifics about India, I'm curious to understand that you're using the word digital. I distinctly remember, 20 years ago when I started my career, it was difficult to get a seamless transition of information. You had to struggle on various websites and publications to get more knowledge about the company. Given that information flow is seamless, investors are well more aware. Do you think they are, just because information is there, have they become better investors? Or investors still get trapped into the behavior of fear and greed?
I think the rise in information flow makes people more confused.
Yeah.
It becomes more difficult because you're bombarded with all this information, many of it not accurate. You must remember, a lot of the information you're getting is not accurate. So you can easily become more confused, which is why investors have to focus on some key elements, which is why I tried to outline in my talk things like are the dividends rising or not? That's it. If they're not, then maybe you should reject that company. Or is the return on capital high or low? I mean, these are the key factors you got to look at. Otherwise, you can get very, very confused.
You just floated your fund about almost a year ago. Just tell us more about your current allocation without getting into size.
Yeah.
But I just want to understand that what's your current, where have you been shopping?
India is right up there with China. China and India are the biggest. And I believe now India's surpassed China in the allocation. Then you have Brazil. We have a little bit in Russia. Wish we had more because Russia's done very, very well. We're in Turkey. And we have a little bit in Indonesia. Those are the main countries.
What's your pitch and what are you buying in India? Are you still buying the good old private banks, which some would argue, and consumer names which are crowded? Or you are ready to bet on some cyclicality and beta in your portfolio?
We want to buy stocks that are really bombed out. And of course, the non-bank financial institutions were one focus that we looked at. And the other area was infrastructure. In other words, companies that supply the goods and services that build the infrastructure. Those are the two areas that we looked at.
What do you make of the current slowdown in India? Slowdown which is now, I mean, everybody's talking about it, we are admitting it. There are pain points which are available. So there are green shoots and there are yellow weeds. But markets are nervous about what's actually happening to the Indian economy. As an outsider, as an investor, what is your view?
Well, the way I look at it is, hey, 5% is very good growth for a country this size. Yes, it's down from where it was, but you must remember going forward, it's going to be more and more difficult to achieve 10% growth that you had previously, simply because the size of the base is getting bigger and bigger. It's getting more difficult. And the same thing with China. 10% growth in 2010 for China was smaller in dollar terms than 6% growth today, because the pie is much bigger. So that's one thing. The other thing is that I think, when you're introducing so many reforms and changes, as Modi has been doing, there is always a period of sort of shock, where people say, oh, wait a minute, this is a big change, let me hold back, maybe wait, this is a new tax, I don't quite understand this, so forth. So then you would tend to have a little bit of a slowdown. But I believe by next year you'll see a big pickup again, when people get used to the reforms that are being implemented.
Mark, we've not had a clean year of earnings in India. First it was demonetization, then we had the transition of GST, then we had the LNFS crisis. This year, the base effect and, slowdown in autos has hit us. Do you think now we could be in for 1 or 2 years of clean earning? Whatever wrong could happen has happened. Now the system is cleaned up. In India, the IBC Act has kicked in. NCLT issues are getting sorted. Do you think the darkest dusk before the dawn is over?
Well, that's what I believe. That's, as I just mentioned, I think that a lot of these reforms that have been kicking in have sort of upset the apple cart, so to speak. In other words, a lot of people are confused how to react to this, how to react to that. And by next year, I think people will begin to become inured to these changes and will be able to move forward.
India has always commanded a premium for its high governance standards. The P multiple in India is much higher than any other emerging market. It's a look at a basket of good banks, good companies. They trade at they get commanding valuations. Given that last 6-8 months has not been exactly great news for good quality promoters, where corporate governance issues have been exposed, leverage concerns have come to fore, is there a challenge that Indian companies which historically have commanded high premium because of quality of business and return ratios, that could get challenged?
If they continue to have good governance, there's no reason why their stock prices can't continue to move upwards, provided that the earnings come in and they're able to adopt to the new internet society. But those companies, you must remember, because of the internet, because of smartphones, because of this incredible speed of communication, it's going to be more and more difficult to hide poor corporate governance. And more companies will be exposed if they have bad corporate governance, and that'll affect their share price. On the other side, those that have really good governance and are more transparent will do quite well, I believe. I mean, it's true globally, by the way, not just in India.
Mark, you know this more than anyone else, that markets, they always follow mean reversion. There's always a pattern which is at play. Sometimes it is dividend investing, sometimes it is growth investing, sometimes it is PEG, sometimes we start valuing company purely based on, the order book ratios they have. During the internet bubble, it was just clicks and eyeballs which attracted things. Right now, it's all about data and artificial intelligence. So for next 4-5 years, which is the big trend, both locally and globally, according to you, which could be at play?
I think the big trend is a change in consumer behavior. This is one thing I think that's probably been overlooked by many, many companies. They don't realize that the new consumer is very different from the old consumer, simply because of their ability to assess the global picture. And you're getting this in politics, by the way. One of the reasons why you have these spontaneous demonstrations around the world, whether it be Chile. I mean, who in their world would imagine that Chile would have such a violent demonstration? Hong Kong. You have it in many, many countries around the world. And that's because there's a whole generation of people who have been growing up with their smartphones, which is a very powerful vehicle to learn about what's happening globally. And this is happening with companies. The behavior is changing. So instead, the young generation, instead of going to the theater, they're watching on their phone, or they're watching at home Netflix or one of these other types of programs. So I think we have to watch that very, very carefully, the changing consumer behavior.
Mark, you've been investing in India for about 20 years plus now?
At least, yeah.
At least 20 years plus now. What has, in your journey as an investor in India, what has always surprised you, and where have you been impressed consistently, and where have you got disappointed again and again? You've taken your chances, but they've always gone wrong.
What surprised me, of course, is the tremendous strides in the growth of the markets, not only in terms of size, but in terms of digitalization. I mean, I remember, I don't know, many of you people may remember the old Bombay Stock Exchange. Right. It was like a parking lot. It was an open air, and people were with physical delivery. I remember people carrying their certificates on their shoulders. I mean, this is...
You've actually seen that?
Yeah, I remember. It was just amazing to me. And then the National Stock Exchange came, and then you had the digitalization, and that tremendous changes taking place. So these are the changes that we've had, and looking forward, we're going to have more going. There's going to be more of this.
So what has disappointed you? What would you say where you burnt your fingers? Because what this audience wants to do is that they want to learn from your experience. Put in your experiences, say that this is 1, 2, 3. Please avoid them in investing.
By the way, this is true not only of India, any other part of the world. What disappoints most is the corporate governance, the managements of companies. Managements will tell you one thing and then do another. Or they may be hiding something under the table. This has been the big disappointment, the transparency.
Can you give an example?
I bet I give you an example because we may get into trouble. But you know what I mean.
I don't know what you mean.
Well, I mean, let's take an example from America. That's a safer place to talk about. Enron.
We know about that.
You know about that.
Tell us something new. Yeah. Tell us something different. Tell us that what we say, the inside gossip of investing in India.
I'm trying to think of an emerging market. Oh, I'll tell you another one. In Brazil, Mesbla. This was a Brazilian department store. By the way, this is another example, another warning. Don't just talk to the finance manager. Talk to the chairman and to the people who control the company and look at their background. But anyway, we invested in Mesbla, which is a very successful, at that time, department store in Rio de Janeiro. And we would talk to the finance manager each year. Things looked good. You know, earnings were going up. Things were great. Then all of a sudden, company's bankrupt. All the assets are gone. They had a car leasing company, that was gone. They had this and they had that, it was all gone. What happened? And we tried to find out. It was almost impossible because the company had been robbed, basically. So one day, about a year later, it was about a year and a half later, we went to the CVM. CVM is the SEC of Brazil. And I said, look, we'd like to talk to one of your directors about Mesbla. We want to find out what happened. And he said, no problem, we'll get a director. And this gentleman comes out. The former finance director of Mesbla is now with the CVM. This is the situation. So I would say this is the
Has that happened to you in India also?
In India, yeah, of course it happened. It happened. As you know, all know. I mean,
Nobody knows, Mark. You're the most experienced person in this room. If you want to learn from your experience.
I don't want to be. Let me leave town first, and I can tell you.
Mark,
That's the reason why I tell people, look at the backgrounds of the people. Try to find out what's their motivation. What is their background? What are their extracurricular activities? Who are they friendly with, et cetera, et cetera.
How has life changed for you when you were managing money for Templeton versus when you're managing for your own firm now? How do you manage it differently?
The difference is that I have more of my own money in these funds than the Templeton funds. Of course, I had money in the Templeton funds, but Templeton was so big. The difference is that we're more focused now. We focus on just a small segment of the universe, whereas with Templeton, we're all over the world, and also in different sectors.
I want to go back to the initial point of your talk, which is value investing is not dead. Do you think we need to understand what value stands for, and measuring value cannot be P multiple and price to book? A classic example here is that, oops, that happens in India, don't worry. How do you define value? Just because something is cheap does not mean it is attractive.
Oh, that's why I mentioned that it's so important to look at the management of the company, the ownership of the company, and find value in these people, the people that are running the company. In other words, are these people capable, high quality, high moral standard? This is part of the value equation. In other words, just looking at the numbers is not enough. You've got to go behind the scenes and look at that. And then the second thing, as I mentioned, try to focus on what is more easily verifiable.
Okay.
Cash dividends are verifiable. Earnings are not so easily verifiable, if you know what I mean, because they can be manipulated. So the big challenge we have is that accounts of companies are done by auditors, or audited by auditors, and these auditors are hired by the management and by the boards of directors. Okay. So you know what side they're going to be on. Now, I'm not saying they're dishonest in any way, but they would tend to make the statements look a little bit different than they otherwise would be. So you've got to dig behind.
Okay.
So that's the reason why very often when we look at a company, I tell the analysts, the first thing they want to do is talk to the management. That's fine. But I tell them, if you really want to learn about a company, don't talk to the company. Talk to their competitors. Talk to the market. Because you'll get another view of what's happening to the company.
It's a great takeaway for, I think, the audience and for me, that when you're analyzing, don't get an outside view to know the inside story, rather than talking to somebody insider. I'm going to hit the pause button here. I'll encourage some questions. We have about 7-8 minutes left. You can raise your hand. The mic's going to reach you. And Mark, before the audience is just making up their minds as to what they want to ask, I'm going to just throw it very wide open. In 1980s, if you invested in Japan, you hit a home run.
Yeah.
If you invested in US blue chips in 1990s, trust me, it was like a golden decade. The last decade exclusively belonged to emerging markets and India. Last 10 years have been extremely kind to America. It's peak America. American economy, American stocks, American financial asset, American unemployment is at an all-time low. Which is that trade for next 5, 10 years? Because that's the way world has moved. Every 10, 12 years, the trend, the cycle, the geography, and the magnification changes.
Obviously, emerging markets, because if you look at India and China, particularly India, India, I believe, is now at the cusp of a big breakthrough in terms of growth and prosperity. So you have to look at these countries that have the potential to grow a lot faster in terms of the economic size of the economy. And I believe India is right up there. China, of course, has had already very, very good growth. They're going through a difficult patch, but they will still be good. But then there are a number of smaller companies. See, the problem in discussing this is that if you're an equity investor in an open-ended fund, you cannot buy illiquid stocks. That's for private equity. So if you look at the universe of opportunities around the world, where would you want to be if you had the ability to invest long-term without needing the liquidity? It would be Africa.
Okay.
Because Africa has got some of the fastest growing economies in the world, and Africa is now in a situation where they are able to leapfrog the technology continuum and go into the latest technology. And this is a tremendous boost to productivity.
Good
So
point.
that's why it's very difficult when you ask, what's the best place to invest? Of course, I have to think about liquidity, which means China, India, Turkey, South Africa, etc. But then if you are willing to take a long-term view and go into private equity, that would be places in Africa.
Okay.
Thank you, Nikunj, and thank you, Mr. Mobius. Those were some very interesting insights from your life. And moving on, it's time for our first panel discussion of the day. To take the stage, may I please call upon Mr. Sriram Ramakrishnan, the resident editor West of the Economic Times. Sriram, could we have you with us, please? Sriram will be moderating this panel that will discuss the efficacy, sustainability, and alternatives of the monetary policy acting as the main engine of economic growth. And may I welcome the first panelist, Ms. Ashima Goel. She's a member of the Prime Minister's Economic Advisory Council, a professor at Mumbai's Indira Gandhi Institute of Development Research. Her papers in institutional and open economy macroeconomics, international finance, and governance have been widely published. Joining her is Mr. Indranil Sengupta, India economist at Bank of America Merrill Lynch. He's also a strong voice on monetary policy issues. Our third panelist for this session is Mr. Jamal Miklai, the CEO of Miklai Financial that he started in 1985. A leading voice on market risk management, he has also served on several key government committees. Mr. Miklai is going to be joining us soon in a minute. We also have Mr. Shomiran Chakraborty, Chief Economist, Citi India, on this panel. He is an expert at analyzing macroeconomic fundamental aspects of the Indian economy. And also joining us is Mr. Viral Acharya, who needs no introduction. The former Deputy Governor of the Reserve Bank of India is in the United States at the moment. But thanks to technology and all the wonderful things that it can do, we have him on the panel with us today, straight from New York. Mr. Acharya has served as a member of the Advisory Council of the RBI Academy, and he was also a member of the Academic Council of the National Institute of Securities Market and SEBI since 2014. Over to you, Sriram, and the panel.
Thank you very much. Good morning, ladies and gentlemen. It's great to have you here. And what we have with us is very interesting and very important discussion on monetary policy as the engine of economic growth. it's a bit oxymoronish to talk about monetary policy as the engine of economic growth, but we'll come to that a little later. And I, had the opportunity to talk to some of the panelists here and got some very interesting views on what monetary policy can do and what central banks can do and all that. But first, we'd like to go across to New York, where Dr. Viral Acharya is waiting for us. And, as you know, it's past midnight in New York, and we'd like to start with him and ask him a few questions. And he has to obviously leave the stage a little early. But if I could start with you, Dr. Acharya. Can you hear us, sir?
Yes, I can hear you. Can you hear me well?
Yeah, we can hear you very well. Dr. Acharya, thank you very much for taking the time out and staying up so late and for this panel discussion. If I could just start, in a broad economic, talking about a broad economic point. Since the global financial crisis, how do you think the role of the central banks has really changed? Has it fundamentally altered from what it was in the past? And are we really looking at a very, very different role that central banks will play from now on going forward? Dr. Acharya.
Yeah, great. Thank you, Sriram. At the outset, just my good afternoon to everyone in the audience. It's nice to be speaking to an Indian audience after a good break of about 3 months. I should also mention that I'm on a self-imposed cooling period of 1 year, so my remarks are more about monetary policy in general, and they don't have necessarily any specific slant or implications for India. Of course, I think economics lies the same way in most parts of the world, and some of these may be applicable to India also. I think coming to your question, my sense is that monetary policy was supposed to function as it did earlier, which is that when there are cyclical shocks, monetary policy is supposed to counter-cyclically adjust to them. Unfortunately, the global financial crisis was a big shock in the sense of affecting the financial stability of many big financial sectors in the developed economies. And what has happened as a result is that in some countries, such as the United States, complementary measures to monetary policy were undertaken, such as very significant recapitalization of the financial sector, reforms, especially on bank capital rules. And the sum total of all that was that while the monetary policy was accommodating, cutting rates all the way to zero, doing quantitative easing, doing yield curve management for the government and perhaps even the mortgage yield curve. Simultaneously, the financial sector was being restored at a fairly frantic pace, I would say. And so the monetary policy, in my view, has returned to normalcy, at least after a significant period of 7-8 years in the United States. In contrast, in some other parts of the world, such as Europe and Japan, this has not been the case. Monetary policy is being used to pursue objectives that it was not meant to be pursuing, such as either saving the currency or substituting for financial stability by doing much of the heavy lifting. As a result, at least the research so far tends to show that the efficacy of monetary policy in these countries has not been that great. And I want to stress this point a bit, which is that financial stability is a prerequisite for monetary policy to get transmitted to the real economy. If you don't have a stable, well-capitalized financial sector, you don't get lending and intermediation to get transmitted from the monetary policy at the right rates to the real sector. And I want to stress this because it's become somewhat Pavlovian to ask monetary policy to adjust when inflation is below target or growth is slowing down. But no one, in my view, should be operating monetary policy or asking for monetary policy to adjust without a clear understanding of the channels through which monetary policy actions are going to transmit to the real economy. Because if it's going to get stuck at the intermediation point, then you've got to ask the question, can you really accommodate to benefit the financial sector for 5 years at a stretch without any transmission to the real economy? If you're doing yield curve management for the government, can you continue to monetize the fiscal deficits of the government or maybe even solvency concerns of the governments, as in Europe, as in some countries in Europe. And as a result, what has happened, in my opinion, over the last 10 years is that objectives, the intended functions, the expectations of monetary policy transmission have become a shifting target. I sometimes jokingly refer to it as kahin pe nigah hai, kahin pe nishan hai, which is you start out somewhere, the arrow is going somewhere else, then you start saying, no, that is exactly where I put it. Or you say maybe it's going to get deflected over a period of time. And I think I'm deeply concerned actually with the way monetary policy is operating in many parts of the world because it is shifting away from its mandate. It's not answering the tough question of how it's going to transmit to the real economy to achieve whatever mandate has been given to it. And I think as a result, it's perhaps a little bit all over the place in different parts. I'll stop there.
Right, that's a very interesting point that you made, kahin pe nigah hai, kahin pe nishana. The former RBI governor, Dr. Raghuram Rajan, had made this point many, many years ago that monetary policy and central bankers especially are in danger of becoming the only game in town. That if they continue to pursue these unconventional monetary policies and the market continues to think that the central bankers are the only ones who can actually save them, do you think, given the fact that the global financial crisis is behind us now, it's been more than 10 years, what is the rationale or the need to continue with these kind of policies? And we're continuing to see it in many countries. I mean, not just in Japan, in Europe, and even in the United States. And we're not even talking about the amount of trillions of dollars that is there earning little or nothing, actually negative rates. And I'll come to that second point a little later. But what is the need for, do you think it's time for central bankers now to kind of step back and say, look, we've done whatever we had to do. Now, Mr. Politician, now the ball is in your court.
Yeah, absolutely. I think that's sort of my view. And if I was the central banker, I would be quite upfront, as you have put it. But I no longer am, and I understand the political reality of some of these conversations. But I think I want to get back to my point about transmission, which is that if the transmission to the real economy is not happening after 10 years of accommodation, this is true in many parts of the world right now. There are two ways to go. Some central bankers are taking the path saying, listen, it'll happen at some point. So I'm going to keep on going down this path. In some recent stuff I've done, I've been referring to it as a cul-de-sac, which is you're just driving down a path where you know you're hitting a dead end, but they seem to be wanting to continue down that path. I think an alternative, a more pragmatic approach would be to actually be upfront and recognize that the monetary policy can only do so much if financial stability is not restored, if solvency conditions of sovereign balance sheets is not restored, if fiscal deficits are not reined in, we can't get transmission to the long end of the yield curve. If these conversations are not held directly by the central banker, and I think it needs to be held publicly because both the expectations of markets, the conversation from the markets to the other regulators, they could be financial stability regulators, it could be the governments, those conversations also have to take place directly. Monetary policy is not meant to address structural problems of the economy. In traditional macroeconomic theory, monetary policy adjusts for cyclical shocks, and that's all it can really be expected to achieve. Other policies have to do their job in a complementary manner. So I think the conversation I would like the central bankers in the world to have is not to say, I will do whatever it takes. I think that's the wrong approach because you can't solve structural problems of the economy with an interest rate or the balance sheet of the government. I think I would like them to basically say, listen, I can buy you time. I can accommodate when inflation is below target, when growth is not up to expectations or not up to the potential levels. But if these other complementary measures are not undertaken, then I'm buying you time. Listen, it's not going to work the way you want the monetary policy to work. And so either I'll have to pull back or we work in tandem. I think that game of chicken, if you want, has to happen in the conversations between the central banks and other complementary regulators and governments. If they don't, I think I agree with Raghuram Rajan that central banks will be left to be the only game in town because they are relaxing the pedal on everyone else to undertake any reforms. The moment you accommodate for another 1 quarter, 2 quarters, 3 quarters, equity investors will be delighted. The firms can borrow cheap, they can alter their maturities to borrow at the short end if the long end is not getting affected. It's a free transfer from the savers in the economy to borrowers in the economy or whoever has capital that can get financialized. But if it's not translating into jobs, it's not translating into growth, I think this is just a wasteful monetary policy because it's going to make precisely the starting problems of lack of wage growth, the lack of income inequality, lack of right distribution outcomes, which are all hindrances in growth generating capacity of the economy itself. Monetary policy will just end up perpetuating them, and I think it is perpetuating them in many parts.
That's what seems to be happening. Thank you, Dr. Acharya. Just one last point before we let you go. You mentioned about structural problems, but there is also one big issue among central bankers around the world, which is on inflation. Do you think they have spectacularly misread inflation?
I think spectacular is a very objective term. I meant to say it's a very subjective term. I think objectively speaking, they have undershot. The forecasts have undershot their achievement. And I think this is deeply rooted in the problems I was referring to in my view, which is that if you don't have the economy structurally right, if financial sectors are not stable, if government finances are not stable, then monetary policy is not expected to transmit into fixing the slack in the economy as rapidly as you would think it is to be. So in Europe and Japan, for example, monetary policy has funded what I like to call as zombie firms, where banks, in order to keep their capital positions, don't take losses on deep distressed assets. Instead, they keep rolling them over, hoping that the central bank will keep throwing cheap liquidity at them, either through rates or through quantitative easing. In US right now, the level of junk bond issuance has peaked. My colleague Ed Altman at NYU Stern, based on his methodology, finds that about a third of firms which are at the cusp of the investment grade are actually not investment grade. They should actually be downgraded. So there's probably some ratings inflation going on in these bond markets because they've gotten used to the steroid of low interest rates and no one wants to, in some sense, call it out. And so if you have these slack remaining in the economy because the firms that should actually exit are not over a period of time exiting, you get excess capacity in markets. If you have excess capacity in markets, the economy remains unproductive because inefficient firms are not exiting. What that does is it brings the potential growth of the economy down. Your statistical models don't work anymore because your long-run averages are based on a healthy set of firms operating in the economy, but monetary policy is subsidizing zombies to proliferate. And because of the slack not going down, because of there being excess capacity, you get sort of depressed prices. Now, of course, there are other channels through which this works perversely. If wrong firms are in the market, then the wages don't rise because the investments are not taking place, and therefore good productive capacity is not being created for the right jobs. So I think the viewpoint I would like to offer is that rather than saying you got inflation right or wrong, I think the question to ask the central bankers is, did your monetary policy transmit to the parts of the economy where you think it should have transmitted? I think if you answer that question, if you get them to answer that question, you will automatically see why they actually did or did not get their inflation predictions right, why they were or were not able to get growth to be restored to the right levels. Because maybe actually through their own action and not being able to get governments and financial stability regulators along, they've actually produced structurally an economy which is very different from what the steady state economy and inflation and growth forecasts are likely to be.
Right.
Let me stop there.
Absolutely, absolutely. And some of those points I think are still yet to be answered in the case of India. But thank you, Dr. Acharya. Thank you for staying up and giving us your incisive thoughts on these issues. It's a very important subject, and I'm sure we'll discuss it in the panel as well, and probably we'll keep coming back on many over the next few months or years on, because this topic is probably not going to go away. It's going to stay with us if you look at what's happening in the US and Europe. Thank you, Dr. Acharya. Ladies and gentlemen, a big hand to Dr. Acharya. Thank you very much.
Thank you, everyone, and
thank you.
Good luck to the panelists. Bye.
Thank you, sir. Jamal, maybe I'd like to start with you. I mean, you had some thoughts on the role of central banks and monetary policy as an effective instrument of economic growth.
Well, okay, thank you for asking me, responding to my request that I should come up early in the panel.
No problem.
I'm the only non-economist here, and I have a thought, an idea, which I think is so obvious to me, but I haven't heard anybody else speak it. So perhaps it is wrong, or
I think you need to hold it a little.
It's not even on. There you go. All right. Thank you very much. Now, just quickly, I'm the only non-economist, and I have an idea which, to me, makes a lot of sense, but everyone else may find very strange. So let me just barrel on with it, because it's the only thing that makes sense to me. Now, as Viral just said, clearly the global economy is in a mess, right? There is suboptimal, very low growth. There is effectively no inflation. There is huge and widening inequality, which has created a lot of political problems, amongst other things. And what I would call the elephant in the room is there is more than $15 trillion of capital, bonds, which are earning negative interest rates, right? And this is money which is being managed by professionals. So, if I were a doctor, those would be the symptoms I would list, And looking at that, to me, a very simple diagnosis is that there is too much capital in the world, right? I think it's obvious. You talk to any private equity investor, there's too much capital in the world. 2 days ago, an investor was talking to me. He's just come back from China, where they are talking not just about unicorns, but about decacorns, which means companies with a 10 billion market cap, startups, right? It's nuts. There is too much capital in the world. But why is there too much capital in the world? And this is where I think I might be in a majority of one. I think there is too much capital in the world because for 40 years, approximately, capital has been given a free ride from a taxation standpoint. It has always been seen as, the princess in the tower, if you will. You don't tax capital, or you tax it very little. And if you do that over 40 years, plus, of course, that's aided and abetted by a huge evolution of an industry called tax avoidance. So, as a result of that, I believe this is the reason why we have so much capital in the world that people don't know what to do. Monetary policy doesn't work. People are throwing money at companies that should not get money. And basically what's happening, the inequality is rising because people with wealth are able to play the curve, just as Viral said, and it keeps widening. It has been going on for a long time, right? In point of fact, the first hint of this came out about 20 years ago during the dot-com crisis, when people were talking about burning capital. Before that, you preserved capital. You couldn't even dream of burning capital. So I'm saying 20 years ago, there was already too much capital in the world, and it's gotten worse. Okay? So this is the prescription. Now, what is the solution? And again, I say I'm no economist, but I feel what I'm suggesting makes perfect sense, right? As it, let's remember, we have no growth, no inflation, huge inequality, and capital that's earning no return, negative return. So here's my solution. It's the first step. We will eliminate all income taxes, all taxes on individuals, on corporates, all indirect taxes. The only income taxes that will be levied will be on senior executives who are making more than, let's say, 200 times the minimum salary, right? So let us say there is a corporate executive who's making $20 million, right? 200, that would be 100,000. The minimum salary will have to be $100,000, right? Now that won't really be a problem because now let's remember the corporate is not paying any taxes either. So he could keep his 20 million. The lower paid people will get more money, which they will obviously spend, right? Now if you do this whole equation with global tax rates, they would release between 20 and $25 trillion a year of money to individuals and companies. So what would they do? Well, they'd spend, they'd save, they'd invest. What would be the result of that? Growth. Remember, we need growth. Now you will only get growth if people spend. So you put the money in their hands.
Jamal, there's a small point about the hole in government finances.
Yes. So but how are you going to fix that, right? Oh, if the government don't get any tax revenues, what are they going to do? Well, it's very simple. As I said at the very beginning, the idea was that capital has not been taxed adequately. So you make this $20 trillion or $25 trillion up from taxing capital and capital-based income. Now, there's, of course, capital gains, dividends, interest on bonds, but that's peanuts. The real capital asset that should be taxed is real estate. I don't want, I don't want to labor too much time on it, but if you do the arithmetic, just from, and the data is a little fuzzy, but the total value, there's 100 billion square meters of real estate, built up real estate in New York. Now, if you say 75% of that is owner-occupied, okay, I'm not going to tax that. Just take the balance, multiply it out by the median price of real estate in New York, you get the value of taxable real estate in New York City alone at 50 trillion. I mean, these are huge, insane numbers. Now, if you multiply that across the world, you'd probably come to something like 2,000 trillion. How much do you need? 25 trillion, 1%. So I'm saying you'd have no tax on labor, if you want to call it that, and you have tax only on capital. And the reason for that is because for years, capital has been undertaxed. Last point, and I'll let it go. Of course, asset prices will come down. Real estate prices will come down. Equity prices will come down. But I think that's good. Because the reality is today, most people cannot afford to buy houses. And the other reality is people will have money. So when the prices come down sufficiently, there will be an equilibrium where the assets would go up again. So like I said, it's a somewhat radical idea. Let me leave it there and let's get some thoughts.
No problem.
Thank you.
Ashima, we had two very interesting conversations so far. I mean, Jamal talking about the excess capital and Dr. Viral Acharya basically saying that, look, you have a lot of structural problems there out in the economy. How do you expect central bankers on monetary policy to fix all those? What do you think? I mean, we've had monetary policy experiment after... Sorry, we had monetary policy experiment after experiment in the last 10 years. Has it really gotten us anywhere?
Yeah, I think I'll start with Jamal's idea since they're most immediate. It would, your plan is wonderful if it could be implemented, but it requires an amazing amount of coordination. Every nation has to agree to tax its real estate. And the main reason why capital is undertaxed is it's mobile. It flies away from a country where it's taxed. So I think the globe as a whole is achieving some degree of coordination, less than what is required for your scheme, because countries are very passionate about their right to tax. They should decide their tax rates, not the globe, right? But companies that are mobile, that are able to go to tax havens and avoid taxation. So I think the G20 and the OECD, their base erosion and profit evasion scheme is really going places. And it's reaching an agreement where firms will have to pay taxes based on their revenue, not the profit. Because like Mark was saying, it's very easy to fudge those numbers. So whatever the contribution, what you're earning in a country, you will pay based on that. And I think that should make a big difference to taxing capital. It's So,
If I may just respond to that, I agree with you that tax evasion is one of the biggest issues. But I'm saying that my main point is that is my diagnosis right? That the problem of the world today is created by a lack of taxation on capital.
right, that is true. And the reason is the mobility of capital, right? And so you have to tackle that. They should not be able to escape taxes by moving to another country, right? So I agree with that diagnosis. It may not be the only problem, but it's one big problem. Now coming to Viral.
Sure. Do you agree with this view that monetary policy followed by central bankers worldwide they've got themselves into some kind of a cul-de-sac? They don't know how to get out.
Yes, but I think you have to look at where it started with the great financial crisis. And if you look at the country that implemented this first, this quantitative easing one, we have seen that the crisis originated in the US, and they were the ones who were able to get out of it. Like Viral was saying, they're the only country which has, in the West, the advanced economies, which has normalized monetary policy. They actually have a positive real interest rate, not a negative interest rate like Europe or Japan and so on. And they were the ones who acted quickly. So I think that it does work in certain circumstances. And it has gone on for too long. It's easier to cut rates than it is for parliaments to pass spending plans. But it's recognized worldwide that in this low interest environment, government spending has been too little. But then again, the problem of governments not being able to tax capital and therefore having to borrow, that is the issue. Parliaments won't pass debt relaxation rules, etc. So it's very difficult to coordinate all that. So then monetary policy is actually the only person who can do something. And like Bernanke used to say, that time, I remember the analysis, I think Aiken Green had a graph which showed a lot of diagnostic graphs going like this and then just like that, absolutely down. So you were heading for another great recession. And I think the policies followed QE and cut to zero rates and so on really did save the US. Now the problem I have with Viral's analysis is that in standard times, it's true, monetary policy should just focus on counter-cyclical around some steady state which is driven by the real economy. But in non-standard times, a major objective of the central bank is the lender of the last resort. Financial stability comes not only from regulations and regulatory actions, but also from providing liquidity. You are the sole provider of liquidity. When markets freeze, as they did in the US, and then asset values, their fire sales and asset values are just sinking. So what is an illiquid situation quickly becomes insolvency. So then they have to step in and save. So now when someone like Raghuram or Viral comes from the US or from Europe or from studying Europe where monetary policy has been overutilized and apply that in India, then it can go very wrong. Because I think if you have to compare India's situation today, it should not be with Europe today, but say with the US in 2008. Because we are seeing something of a market freeze. If you see our data, there's such a sharp fall in credit the last 6 months. It's because for whatever reason, the financial sector, if it was true that by abstaining, keeping monetary policy tight, you force governments to solve structural problems and the financial markets start working perfectly. The last 10 years, since 2011, India has been following very, very tight monetary policy. Financial markets should be working perfectly. But they are in very bad shape here. They're not providing credit at all.
Absolutely.
So it could be when the rest of the world, I think Mark made this point, had negative interest rates. For our firms, the real interest rate was something like 12% because the CPI was high, but producer prices were very low, negative. And how can you do productive investment with such high costs?
With such high rates. Right. If I could come to you, we've had RBI cutting rates over the last, say, 1 year or so. We've had liquidity now coming back into the system. But you still have very, very poor credit flow. I mean, as Ashima was saying, credit seems to have just fallen off a cliff. It's probably better than what it was in October last year, but it's still very bad. Transmission, central bank acting too late, too little. What do you think are the reasons?
I will say that, the problems we face today had their genesis in the liquidity crunch of last year.
Right.
both in terms of the RBI hiking rates and not providing liquidity. Now things started turning somewhere around December, and of course the first rate cut was in February. Now I think there are 2-3 things here. Number one, when the RBI puts in 1 rupee of primary liquidity, it takes at least 6 to 9 months for that to convert into, let's say, 5 rupees of bank loans or 7 rupees of money supply. That gestation lag, I think, got further elongated by the fact that we had elections, and that led to a drawal of cash. So it's really somewhere around June that you've seen that process starting. So clearly a lot more time to go before the RBI's measures bear fruit. So that's one. The second thing that has happened is a collapse of commodity prices, a collapse of the WPI inflation. WPI inflation is down almost 250 basis points. So as a result, what has happened is that your real lending rates have actually shot up despite RBI easing. So if you see the MCLR is down 40 basis points, but if you adjust it with core WPI, that's up 120 basis points. The average lending rate has actually not come down. It is up 8 basis points. And therefore, the real average lending rate is almost up 200 basis points. So given that you had these two shocks, the collapse of commodity prices on the one hand and the elections on the other, I think that it will take at least 3 to 6 months more for the RBI's measures to pan out. So I think that, maybe at some stage, the RBI will have to think of direct measures to bring down the average lending rate. It could be a CRR cut, it could be a subvention for the SME sector, but there is clearly a longer period.
So you think the rate cuts are not helping?
Rate cuts are helping, but they need their time to bear fruit.
Right. Samiran, I should come to you, and sorry for this delay in bringing you up here. What do you think is really happening with the central bank formulating monetary policy and acting as a real engine of growth? Do you think that's still valid in current circumstances, or like as Dr. Viral Acharya said, they should now just pull back and let the governments do their bit?
Yeah, I think Dr. Acharya and Dr. Goyal, they had somewhat of an opposing view from a very long-term effectiveness of monetary policy perspective. Yeah. So, and the big question was that what is the Japan story versus what is the India story could be very different.
Right.
So let me stick to something which is less controversial, which is what monetary policy is supposed to do. Is it even doing that? And that's a question of whether the rate cut that RBI is doing is at all getting translated into lower lending rates or general rates in the economy. So we look at 3 different parts to it. One is the RBI rate versus, say, a 1-year government security rate. Then you can have a term premium on top of it between the 1-year rate versus the 10-year rate. And then you can have a spread which is between the sovereign versus the corporate bond. And what we see is that the so-called real policy rate itself is second highest for India in Asia currently. And if you look at the term premium is almost 50-60 basis points more than what the last 6 years average has been. The only area where we are seeing some improvement coming is that the corporate spreads have started narrowing down a bit, which is, I would connect that more to sort of sentiment improving measures taken by the government and less connected to the monetary policy side of it. So this is where the struggle is, that the rate cut itself is not getting translated. And on top of it, we have a peculiar problem which Inel was referring to, which is the problem of the supply of credit.
Right.
This is only the cost of credit. On the supply of credit side, we are seeing this very interesting phenomenon that the RBI is creating money at 15% year-over-year growth, but the actual money supply in the economy is growing only at 10%.
Right.
And this is an area which, in my view, one solution is a CRR cut sort of thing, which will drive up the money supply growth also. But I think what is, and this is true globally, that it's connected to sentiment. So it's like RBI is putting up a tap, but there is the pump in the financial system which gives leverage to this money. That pump is not working. And that pump will work only when you will have enough confidence in the system, and that's when both the engines will function, that you will have both lower rates as well as availability of credit improving. That's when monetary policy can be effective.
Sorry, but when you talk about the pump in the system and you talk about the sentiment part of it, how much of a role can RBI or any central bank really play? Because if you talk to any bankers, and I'm sure all of you keep speaking to bankers on a regular basis, you speak to any banker, there is a genuine fear of lending to certain sectors. There is a genuine fear of lending to probably industry as such. I mean, some of the biggest banks saying that we want to push up retail credit to a particular level, 60 or 70%. How does one solve this? And maybe I can ask any of the panelists to respond. Maybe Samaran can have a go at it first and the others can follow. Sure.
30-second response. I think there are no easy answers here. But the thing is that in any cyclical downturn, you will have sort of risk appetite reducing.
Going off, yeah.
But the fact that you have 2.5, 3 trillion rupees of excess liquidity in the system, at some point of time, will have to flow into the economy. It's difficult for us to take a call on whether it's going to be 3 months, 6 months, but I can't believe that a bank will keep on parking this as 4.9% in RBI forever, where there is an opportunity to lend at 12%.
Right.
That doesn't make sense.
Ashima, your views?
Yeah. I think that you have a credit risk and a term premium risk, both of which are elevated in India. So this issue, we made a big mistake last year in the sense that durable liquidity was very tight, as well as the LAF, because of outflows, and just at a time when the NBFC crisis, that means sectoral liquidity. And this liquidity drought continued for very, very many months, much longer than it ever had. And so it really killed consumption. I think the NBFCs were financing a lot of people who were excluded. And we've seen the outcome in terms of growth falling, etc. And then there are worries about these fire sales, that when the asset values decrease, then bankers are worried that, and they're not willing to lend. So that confidence has to return, that credit risk. And I think the government has taken a number of measures. We're seeing signs that things are bottoming out, even in the housing market. There's some improvement. Slowly it will percolate. Like Samiran was saying, if banks, the option is you have huge excess liquidity now and you're getting very low interest rates, you have to pay those depositors, you have to earn. So there is an incentive for them to go out and find people to lend to. But the second, this term premium, that is also higher than it has ever been. And this is related to our dilemmas about the fiscal deficit. For some reason, we think government borrowing is too high, markets think. And, coming back to the parallel with global monetary policy, what did the US do in QE1? They bought US government securities. The Fed did that. And in India, the RBI did a lot of this for, after the big drought when they were building up durable liquidity. But recently they announced that they're going to use FX swaps or whatever. And we're seeing a lot of inflows. So then the central bank, you're getting, again, foreign securities, but you're not buying local government securities. And I think this we need to think about, because if there is a parallel between India today and markets freezing and term premiums being elevated, then the part of transmission is to get those term premiums back to the normal 60 basis points. And I think an announcement of open market operations, that's one way that transmission can improve also. So.
Right. Internil? Sorry, Jamal.
Yeah. I think another issue that is basically investment sentiment. I mean, we're talking here about the supply side of credit,
Yeah.
But ultimately, I think basically in the country today, investment sentiment is quite negative. So, okay, there are difficult borrowers, but there are good borrowers who are not borrowing. People are investing overseas rather than locally because they're really not sure as to what, let's say, very uncomfortable about what the future holds. I think that's another element in the pot.
But that's something that the government can probably do, and it's probably doing to some
Absolutely,
extent.
I understand that. I'm just saying that is another issue today.
Right. Internil, your views
I just
on...
wanted to, say that there's another committee where Dr. Goel and I sit, and a point she made that, in a war, you don't give up. So, this is, you are seeing the RBI cut rates, provide liquidity. The government, I think, is taking measure after measure. But then they all need 6 to 9 months to pan out. So we have to put up with some more pain. And, as you probably the RBI cuts somewhat more, I think they're fairly on course on the durable liquidity side. You will see slowly, interest rates come down and the transmission happen. But it can't happen overnight.
Yes, when people say that M3 is not growing, even though reserve money, MO is growing, and therefore MO should not grow, that is absolutely the wrong analysis. Because if M3 is not growing, you need to expand the central bank balance sheet, grow MO more to compensate, so that at least the money supply growth is equal to that of nominal income. No?
Right, absolutely.
And because the other important point is that inflation is contained. The long period we were fighting inflation, though a lot of people believe inflation is overestimated now. Mark was making this point again, the digital economy, actual inflation is much lower. And worldwide inflation is so low, that's going to affect India also, which is increasingly
absolutely.
digital.
I mean, it's an
So then even under inflation targeting, you have room to cut rates. So you should not say that monetary policy is not working, and therefore we will stop cutting rates, when as an inflation targeter, your real rates are too high.
Right. It's interesting that you're bringing this up. Dr. Viralacharya also pointed to that. Have the central banks really misread inflation? Or is it just a case of technology just galloping ahead so fast that the real world is probably just trying to catch up with it? Samiran first and then Ashima, and we can go around.
I think I will take from Mr. McLeigh's point that it's now well understood that the share of capital has gone up so much over the last 40 years, and the share of labor has declined, means that the bargaining power of labor over time has come down. So that's why the wage growth has been significantly lower globally, despite output actually staying close to potential output.
Right.
And this is a very peculiar problem which breaks down what we economics normally take it as an axiom that there is a wage price spiral.
Right.
So then despite any commodity price shock, it does not get transmitted into a wage price spiral,
wage growth,
and overall inflation stays low over a significant period of time. And that's why we are seeing this very peculiar phenomenon that in US, unemployment rate is at historical low, but they're barely getting 2% inflation.
Right, right.
And I think in India also this is getting reflected in an odd way, that earlier we used to say that food prices get very quickly generalized into core inflation because of wage bargaining power.
Right.
Whenever food prices would be up, you would ask for more wages, and that will just get generalized. But that's not happening anymore, because in India also, my sense is that the share of capital going up and labor's bargaining power coming down is breaking that channel through which typically we economists think of wage price balance.
Right, break the channel. Indranil, have we really, won the war against inflation in that case?
I think that, what you're seeing is low inflation because of low demand. And what you really want is, growth maybe at a potential level. I mean, whatever that be, probably somewhere between 7 to 8%.
Right.
And, you can live with inflation somewhere between around 5 to 6%. So what is really happening right now is you're seeing low inflation at the cost of growth. So that's number one. The second is that, understanding inflation has also become, a statistical challenge because there's so many base effects. So inflation is going to now rise. It will probably hit 5% next month. It will probably average around 4.5% for the next few months. Because last year around this time, inflation fell to 2%. So when you read inflation, I think it's very important not to read it on a month-to-month basis, to see it over at least, a 1 year span when you do monetary policy. So I think, in a way, the challenge for India is also to deflate and bring back growth rather than, continue to depress inflation at sub 4% levels.
Right.
Can I come in?
Yeah, sure, please.
Yeah. I think we need to distinguish between headline inflation and core inflation. So core inflation is what reflects the demand in the economy. That is very, very low. WPI inflation, which closer to producer prices, is 50 basis points, almost zero.
Right.
But the earlier in India, Samiran's story about this wage price spiral, I think we are not that advanced. I think that labor has no bargaining power. But in India, the wage bargain was very closely associated with food inflation, especially in this 2007 period when we had sustained high food inflation above double digits for a number of years. Then you saw real wages begin to rise, agricultural real wages. But the spike we are seeing in inflation today, after that food price inflation has been very, very low. So we are sensitive to oil and food inflation, which are part of headline, and that affects other prices, wages, and general inflation. But the oil economy has changed in the world because of shale and bargaining. We are not going to see sustained rise in oil prices. That is a positive for us. Then there is, I think, real productivity improvement in agriculture, which has kept food inflation lower. And the current spike is related to the floods.
Vegetable prices.
Vegetable prices, very seasonal. So as a monetary policy authority, you have to look through seasonal spikes which are not going to manifest in wages and general inflation. So even if headline inflation, which the central bank is targeting, goes up beyond 4, but it's still less than their upper band of 6, they have to look through it because core inflation is just 50 basis points, and that is what is the real interest rate facing industry, which is going through a slowdown, right?
Right. So there are actually two major problems or issues for the RBI and for the government. One is that whether Dr. Surjit Bala, I think, has a paper on it recently, is ultra low inflation really good for India? If that is indeed the case, then what is it that they need to do? And or is inflation going to really come back? And is it just all that we've seen in the last 1 year is just a bit of a base effect or some other low demand effect, which is really
that was precisely the point I was making. That you will see headline CPI inflation go up, but you have to see it in the context of the 2% base. So right now what has been happening is that CPI inflation has been 3.5% this year, 3.5% last year. Now what will happen is it will probably go to 4.5% to 5% this year versus 2% last year. So you got to take the average, which is 3.5% and way below, I would say what is optimal for the economy.
Right. Samiran, how do you see this issue playing forward in the next, say, 6 to 8 months or so? Are we going to see inflation down on RBI?
So, just a quick trivia is that if vegetable prices normalize, then it's a 120 basis point impact on inflation. So your headline will come down from 4.6 to 3.4 with nothing else moving. So that will give you a perspective on where inflation stands in a true sense of the term. But I think your broader question was that should we start worrying less about inflation?
Yes.
I would differ from my rest of the panelists on this. I think we have taken a very strong stance that inflation will be our nominal anchor. We can't keep on changing the nominal anchor every few years. That will confuse policymaking, confuse markets even more. We will have this healthy debate going on which is the right nominal anchor, whether it should be headline CPI, core CPI, WPI. It will keep on going. But fact of life is that we have to stick with it for a significant period of time to get the benefit of that anchor.
Yeah, and can I just comment on this?
Of course, please.
I think, Samiran, I agree with you that this anchoring of inflation expectations is very important. The communication that inflation is going to average 4%. We've done some research at IGIDR which shows that it is affecting household, but it's the announcement effects that inflation targeting has a short-term effect, but it's cyclical, structural sort of changes, the core inflation which matters more for the long term. So the inflation targeting which we've imposed at considerable pain should not be given up. And another issue, but that itself, that regime is giving us space to cut still, because it is a 4 to 6% range. And even with the spike in food prices, we are below that. And when growth is so much below potential, there is a weight to growth also. And core inflation is so low, there's still space to cut. Your real or neutral interest rate is too high. But another sensitive issue in India is when you talk to bankers and so on, they are they say they have to worry about competition because they have to have higher to attract deposits. Now, people have avenues such as equity and mutual funds and so on, and they will go away when there's a sort of money illusion here. Savers are actually getting a real positive return. Earlier, they used to get 12% nominal return with 14% inflation, so it was actually a negative real return. But people think that, oh, I'm getting so little money on my fixed deposits, and there is a concern, say, about senior citizens who need some absolute amounts to meet their budget and so on. So here, I think the point that came in the earlier session, in Europe, where about the global monetary economy, where real interest rates are negative, bankers are still paying a positive rate of interest to household deposits. But they're charging firms negative interest rates, and firms need those liquidity services. So I think in India, one answer is to have differentiated interest rates, higher for, say, senior citizens. They're already high. They can be even... So, to meet this psychological sort of, and that, or taxes on bank deposits can be removed for certain categories and they're competitive with equity. And so we need to think of this sort of issue also when we are...
Right. So on the issue of the inflation...
We're moving to lower nominal rates and therefore lower interest rate. Lower inflation and therefore lower nominal interest rate.
So on the issue of the inflation band, 4 to 6%, you're not in favor of extending that band or increasing that band a little more. You're fine with where it is.
Use the flexible inflation targeting. The word flexible, I think,
and you have 2 years to, where you can deviate from the band without. So there should not be overreaction. I think in the early years of implementation, central bank has been too strict, too worried about meeting that band.
Right. Okay. So we're running out of time. I just have time for one last set of questions, and I'll start with Jamal on this because you started off by saying that you're the only non-economist here. So you're the man from the real world, so to say. So if you look at the future, if you were to ask you to gaze into a crystal ball and see the future where technology and digitization is going to play a huge, huge role, what is the kind of role that you think a central bank should play on a number of things, whether it is to do with bank management, markets?
See, frankly, I was thinking before this really about the global economy. India is clearly in a different picture,
Sure.
I think, but I think the one thing that is should apply in both cases, historically, they used to say a central banker was someone who took away the punch bowl right before the party started. Now, very clearly, globally, what's happened is they have been the bootleggers. They have been delivering the booze, right? Yeah. So I think that principle should remain in India, right? Now, there may be differences of opinion as to when the party starts or where the party is right now. And I also feel, really the point I raised earlier and I mentioned again, is that we're focusing really on monetary policy and the central bank. But you can't do that sort of in a vacuum. I mean, the government, fiscal policy, sentiment, I mean, all of it is one pot. You can't play you can't play this musical instrument alone.
Right, right. Indranil, your views?
I think that, in India you have this 1881 Negotiable Instruments Act, which says that all transactions must happen through the banking system and the RBI. So as long as that act stands, you could have more and more of financial innovations, but they would still go through the banking system. So I don't see much changing in India, at least, in the next 10 years, unless you are really talking of scrapping that act.
Right. Okay. Samiran, how should monetary policy, you think, evolve to face the challenges of the new world?
I think I'll go back to where Dr. Acharya started from. I think the role of central banks in maintaining financial stability. I think that's going to get more precedence over time because as people realize that the technology, etc., is the supply side boost to long-term growth. So growth is going to come from there.
Right.
Central bank's ability to spur that growth will become increasingly less relevant.
Right.
And central bank will be left with the job of maintaining financial stability and
right.
supporting that growth.
Right. That's an interesting point. Ashima, what do you think of that?
Yeah, I think as we move to being a mature economy and we have low, stable inflation and high growth, then, but internationally also there's a huge focus on macroprudential tools for financial stability. So one of the issues in India has been the central bank is the regulator of the banking system now, of NBFCs also.
Right.
So you have to, financial stability can mean both liquidity in bad times, counter-cyclical macroprudential regulation. They should not be pro-cyclical. So you take away that punch bowl from the financial sector when they're partying, it's boom, euphoria, but you provide them support when they are
when they are in
and
tough
so
times.
on. So you need to move towards counter-cyclicality in macroprudential regulation, and that should coordinate with monetary policy. And monetary policy and fiscal policy must coordinate. I think another mistake we made was we took autonomy to mean they don't talk to each other. You know, with Viral, you get the view that the government is the enemy. That is not the case. They are both our agents, and they have to run the economy so that all of us benefit, and they need to talk to each other. If the government is taking measures which are keeping inflation low from the supply side, the Reserve Bank has room, space to accommodate.
Right, right. We saw how that really played out last year. But thanks, Ashima. On that very hopeful note, we will end this panel discussion here today. Thank you, all the panelists. Thank you, Indranil. Thank you, Jamal. Thank you, Samiran. It's been a great discussion and some very incisive, very insightful points. Dr. Acharya also joined us briefly, and I hope you enjoyed the session. There's much, much more discussion and really high-quality stuff to look forward to. So please stay out here and enjoy the day. Thank you very much. Thank you, everybody.
Thank you, Sriram, and members of the panel for that interesting discussion. And moving on, our next session celebrates 25 years of stellar run of Dalal Street's most celebrated money manager, Prashant Jain, the ED and CIO of HDFC Mutual Fund. He is known for his distinctive fund management style that is second only to the legendary Peter Lynch, who managed the same fund for a quarter century and delivered alpha of nearly 10% over the benchmark. Lynch managed Fidelity Magellan for nearly 3 decades, generating an alpha of nearly 11% consistently. And we have Mr. Nikunj Dalmia, Managing Editor, ET Now, in the driver's seat. He will be in conversation with Prashant. And while you listen to that exciting fireside chat, do remember to keep the tweets coming with the hashtag ETMGS, and our Twitter handle to follow is ETMarkets on Twitter. Thank you. Over to you, Nikunj and Prashant.
Do not put your mic. Well, good afternoon, everyone. Is everyone settled down? You want me to start? Raise your hands if you want me to start, or I'll wait for people to settle down. Very few hands have been raised. That means people want to settle down. At the back, you guys would like to sit before we start the session? Okay. This session is all about understanding investing. For someone who's seen many booms and the bust in the market, how he has been such a standout investor, what Prashant has learned from his mistakes, what his reflections are, what has he learned about India, and is investing in India very, very different from other markets. So Prashant, fantastic to meet you again. I always look forward to our engaging chats. I'm going to start with something very simple. It is often said in the market that investing by difficult cheez nahi hai. Investing is very easy. Investing is common sense and a little bit of patience. So if investing is so simple, how come you don't have too many billionaires on the street? How come there's only one Prashant Jain? How come everybody is not rich?
No, I think one, I'm not the only one. There are quite a few who have done very well in the markets. May not be in a mutual fund format for 25 years, but there are quite a few of them. But yes, it's, I mean, equities are a very simple asset class, but as is said, what is simple is always not easy. I think to do well in equities, we need right understanding, which can be very easy for some and can be very challenging for others. And I think apart from right understanding, we need lots of patience, we need tolerance for volatility, and we need the discipline to, one, remain diversified in my opinion, and two is not to deviate or compromise from what you believe is good for the long term.
You started your career as a fund manager. That is not a typical migration for a lot of fund managers. They would start as an analyst, migrate up to the buy side, then the sell side, then the buy side, and become a fund manager. So when did the realization kicked in for you that I wanted to be a fund manager? Because being a fund manager means that you need to understand cycles, valuations, macro environment, interest rate environment.
So Nikunj, this will be tough for you and those in the audience to believe, but fact is, I had written civil services and I had actually qualified for them, for the civil services. I went home to discuss with my parents, and it took us 10 days to decide that I would actually not join civil service.
Sarkari naukri versus private naukri.
So I had an offer from SBI Caps those days. They was a day one company and I was at IIM Bangalore. And I joined 10 days late behind my batch. All my other batchmates, I think they hired 14 people that year from IIMs. So I was the last one to join. And when I joined, Mr. Shriram was the GM. And he said very apologetically, son, I am extremely sorry. All the good postings are gone. And all you can do now is equity research. Seriously. So those days, project appraisal, merchant banking, marketing was preferred over equity research and fund management. And that is how within a short period of 2 years, I was made a fund manager.
So if your son walks up to you now, you got two boys, they say, Papa, fund manager ya fir civil service, what will you tell them? Which is the most stable career now for next 20 years?
I think unless you are, really passionate about equities, most people say that, but actually they don't know enough of it, and that's why probably it interests them more. But I would say civil services.
Civil
and I will
services.
explain it to you why.
You're not being politically right.
No. I will, data is king. See, it's a misnomer in the country that private sector pays more. Nothing could be farther from the truth. You look at the average salary.
Ms. Goyal is just gone. You should have said this earlier. Where's Ms. Goyal?
No, but
She's
it's
there.
a fact. And this entire country, I think, believes otherwise. But see, I think what has happened is because the media highlights only the most successful people in the private sector, who, of course, can draw any amount of salaries. There is an impression that private sector pays more. It is not true at all. The starting salary of an engineer in public sector is about 4 times that of the starting salary of an IT engineer. The average salary, and I'm saying average salary meaning the total employee cost divided by the total headcount of a public sector company is 60-70% more than that of a leading IT company. Because of very large addition to the white collar workforce, large number of engineering MBA colleges, the white collar salaries in India in private sector have actually degrown in real terms.
Okay.
Yes. But of course, and the final thing is, I think equities are the survival rate here is very low. And I have I've been in this industry for 30 years. And I see the financial services, particularly beyond 40, to retain a good jobs becomes increasingly challenging because your costs keep on going up. And in financial services, the only cost is wages. So if you are not up to it, or if the downturn comes, it is the middle to senior level people who are often the casualties.
So I'll take the clock back when you started your career, and obviously that was a different India. Our GDP was nowhere close to even $1 trillion, must be 100 billion or 250 billion. Today we are at 3 billion, one of the fastest growing economy in the world. We can cry about the fact that growth's come down from 7 to 5, but 5 is the official data. Did you ever imagine that 20 years from now, 30 years from now, when you started investing career, we could have a Tata, TCS, which has a profit of 35,000 crore, or Reliance, which has a projected profit of 40,000 crore? Did you fathom this kind of size for India?
I mean, to give you a very correct answer, no. I never thought that long. And I have tried to do the best every single day. I have tried to think ahead in terms of investing, but clearly I don't think I ever thought that we would become this large, we would have this big companies. But one thing I must say is that I had a firm belief and a desire to remain in India and to work in India. And I understood this much, that given the demographics, the natural resources, and the capabilities of people in this country, that this country will continue to grow. But clearly, I did not extrapolate 5, 7, 8% growth 30 years out and actually work down that this will become such a large economy.
For those who are worried about slowdown, global growth, drop in autos, do you think the strength of India will prove them again? The strength of India will prove them wrong once again?
Oh, I think for sure India will, the growth will bounce back in India, but it could take a little bit time. See, I think what is happening in India, is going back to the same issue what I raised earlier, the white collar wages in India have degrown in real terms, and new avenues of consumption have arrived in India. Like the mobile handset market is as large as the car market. And if you don't have enough money, you would clearly buy a mobile phone over a car. So I think this is what is leading to a drop in consumer discretionary consumption in India. But I think the two steps which the government has taken, one is to cut corporate tax rates. And given the backdrop of the US-China trade war and the fact that Chinese wages are now higher than Indian wages, the manufacturing wages, and their manufactured exports are almost 7-8 times of India. I think a serious attempt is being made and should be made to encourage global companies to set up shop in India. And yesterday I think I read in one of the papers that government has identified 323 global companies to whom they will say, we have lower tax rates, we have a huge local market, this is the piece of land, water, power, what do you want, please come here. I think that is what will revive wage growth and economic growth in India. And I think given the deadline of March 23 for a concessional tax rate for new manufacturing units of 15%, I think sooner than later we should see good movement on that front.
Post the tax cut, we've not seen a large indication or announcement from any of the large corporate houses that look, they're ready to commit capital. Is that the challenge right now, that corporate houses either are scared or they don't have the ability or the will or the scale to commit capital? Because cycles start, investment cycles will start when you have large corporate houses, they start investing a lot. I don't see that happening in any of the large sectors.
See, I think you need to divide potential capex by private sector in 3 areas. One is in, some businesses are fundamentally less capital intensive. Let's say FMCG or services businesses. And no matter what taxes you cut, they will not spend more because they simply are in that type of a business which needs capital expenditure. The second are the capital intensive businesses, and these are businesses like power, infrastructure, when you build a road, own a road, or metals typically. Now, unfortunately, in these 3 sectors, which drove the capex cycle in India last time around, many of the companies are in they have very difficult balance sheets. Many of them are under the bankruptcy proceedings. And the ones that are healthy, they would rather buy the existing assets under IBC, which are cheaper. I mean, if you look at all the power plants that are being sold or will be sold, they are nearly half of the replacement cost. So as long as existing assets are available to me cheaper, I don't think new capex will revive in the capital intensive sectors. I think this IBC process and the most of the existing assets will find new buyers or new homes by March of this year. And I think post that, we should see private capex revive in these areas. And that's why I said earlier that the real opportunity for India in the near term is to get those 300 or whatever global companies into India. Because please appreciate, we buy a Samsung television, we buy a whatever mobile phone. If an Indian company puts up a TV factory or a mobile factory, we will not buy those phones. So our consumption basket, which is tilted more towards imports, we need to bring those companies in, and they can make for India and they can make for the world in India.
You're a firm believer of cycles. It's not that you've not bought consumer stocks in the past. And in 2008, 2009, one of your largest holding was Titan, followed by Page. Now you don't have consumer stocks in your portfolio. Why is that?
So I think, I don't subscribe to this view that good business is a good investment at any price. And that is not borne out by my experience over last 3 decades. So certainly we should buy a sustainable business, but beyond that, for a good business to become a good investment, the price must be good also. And I can give you several examples, like if you bought IT stocks in late 90s, early 2000s, for 10-15 years you made hardly any money because they were so expensive and future growth was discounted by 2000. If you bought FMCG companies in 1995, for the next 10 years there was zero returns because they were so expensive in 1995. They were growing businesses, they were great businesses then, 95 and 2005 as well. So I think consumer stocks in India today are, to my mind, are trading at lifetime high multiples. Never before in my experience they have traded thus so expensive, and nowhere in the world they trade at even probably half the valuations. So I think while these are good businesses, sustainable businesses, but the expectations from these, to my mind, are unlikely to be met. And let us not forget that many of these are reasonably mature businesses. India sells 2 crore two-wheelers a year. And I think maybe in India there are 15 to 20 crore two-wheelers on the roads. So almost 2 out of 3 families own a two-wheeler. Soaps, shampoos, toothpaste, these are good businesses again. But to expect them to grow very fast, I think is not correct because they are reasonably mature businesses. So I think we must pay, I want to pay good attention to what price I am buying apart from the sustainability of a business, and these businesses don't pass the valuation test.
But if one looks at the India story, it is perhaps, with the exception of Reliance, it is centered around consumers, autos and private banks. You don't have a very large manufacturing company. You don't have anything very large which has become an export front company in terms of manufacturing. Why is that?
So I think that is true then because it is hard to explain and probably unfortunate. In 90s, till 90s, India's per capita income was same or higher than China.
Is it true?
Yes. And today Chinese per capita income is 5 times of us. And I think while we made a success in the services industry and India dominates the world, but I think in manufacturing, China went decades ahead of us. And so if you look at the composition of the Sensex today, and you are right, that there are very few manufacturing companies in that. 30% is financial services, 20% like IT, pharmaceuticals, and oil and gas and metals. They are global cyclicals. So that is 50% of the market. Another 20% would be consumer discretionary, non-discretionary. That's 70, and there's only 10% is companies like Larsen Toubro. So you are right that and it shows up in our GDP composition. What is the contribution of manufacturing to GDP? But I think all is not lost. Today Chinese wages are, for the first time in my career, in the last 1-2 years, Indian companies in chemicals, textiles, what else, auto ancillaries, they tell us, look, the wages or the cost of manufacturing in India is lower than China. That was not the case 15 years back. The compliance with environmental standards is improving in China. The subsidies are reducing. So India is now competitive in rupees terms. And that is why I think this tax cut has come at a very opportune time, that India offers the advantage. See, look at it this way, our manufactured exports at 300 billion are roughly the same size as a Vietnam, Thailand or Indonesia. And they are countries which are 1/10 the size of India. And China is 2.5 trillion. So I think given the right tax rates, given the right environment, and the advantage of a massive local market, which none of these neighboring countries have, I think it is reasonable to expect that many of these global multinationals who are present in China, when they move out of China or reduce their footprint there, India will get in future a higher share than what we have got so far.
So you mentioned the weightage of the Nifty. The weightage of the Nifty in 2000 was very different, dominated by TMT. 10 years from now, 8 years from now, what to your mind could be the face of the Nifty? Because that's why we'll understand that where wealth is going to get created.
So I think it has changed. In 90s it was very different, by 2000 it was very different, 2008 it was very different, and today it is very different. And it probably reflects both the economic growth and which sectors get undervalued or overvalued. Like tech, I vaguely remember in late 90s or early 2000 was almost half of the market weights. But it was reflecting as much the growth of the sector as the overvaluation, because these are market cap driven indices. I think, so let me comment on the growth. Where will growth come from? I think investments should outgrow consumption in India, clearly, to my mind. And unless you do that, it will be very tough for this economy to grow. Household debt in India has gone up very sharply. It used to be 2% in 2000, today it is 20%. Our savings rate has dipped in last 10 years. In 2010 or 2008, our financial savings rate used to be 12%. Today it is down to 8%. Never before in India has our financial savings rate fallen. I think that is because the white collar wages have degrown. So I think the only way to fix this is to grow your investments. If investment grows, you create more jobs, it gives you more salaries, and then you can come back and spend. And again, most countries that have experienced rapid economic growth in the past, it has been driven by exports. So whether it was Japan, Korea, Germany, it has been China now. So I think when these global companies come to India, hopefully it will increase our merchandise manufactured exports as well. So I think in the future, businesses that will grow faster will be around capital spending, around manufacturing, and of course financial services, I think, will keep pace with the GDP growth.
The recent downturn which we have seen, and if I look at the quarterly numbers gone by, HUL has managed to grow, Bajaj Finance has managed to grow. Big companies are the only ones which are growing. Are we in an environment where the existing 50, 70, 100 companies will become giant companies, giant will become mega, and mega will become, monster?
So I don't think there can be any generalization to that trend. And we have seen in the past that there were, if you look at NBFCs, for example, many NBFCs pioneered a new area for credit. But over time, as that area became addressable by banks and as it became large, banks entered. And then they gained share back from the NBFCs. And I think the way, for the first time in this season, I think some leading banks offered you loans for very small consumer items. And today in India, you can get an EMI on a debit card as well. So I think over time, banks will be able to address the small consumer loans market, because it will all be digitally delivered. And they know their customers extremely well. It will be driven by analytics. So I think while those companies which continue to be ahead of competition, they will do well. And there is always space for companies which execute better. But I think banks will be formidable competition in the days to come, even retail, small retail loans. As far as Lever is concerned, it's a great company. It has outstanding brands, extremely well managed, global best practices. It continues to grow, it continues to premiumize. But Lever continues to grow at broadly the same rates at what it has grown for long periods. So I think Lever's business is reasonably easy to forecast, and where people have different views is what they are willing to pay for that quality and for that growth.
If I look at the track record of the fund which you manage, you've taken contra bets, not yesterday, not last year, but in your entire investing career. You bought stocks, you bought, for example, corporate banks when everybody was focusing on retail banks. You bought into PSUs when PSUs, in a sense, were not the popular trades in the market. You bought consumer names when there was a perception towards infrastructure. How do you come up with a thesis, an idea, and conclude that it's time to go contra? Are you buying it because they're cheap? Or are you buying them because you have compulsions of a fund manager? If you have compulsions of a fund manager, it's very easy to map the Nifty and stay with popular stocks. But you never do that.
So I am extremely non-violent by nature. So I don't believe in contra investing, but I do believe in value investing. And if value investing at a point of time means that you think differently from others, then so be it. So I want to, as I said earlier, I have always tried to buy reasonable quality businesses, not always high quality because sometimes they are very expensive. And I have always focused on what you pay for them. And it is quite logical that when a good business is passing through a challenging time, or when some other businesses are doing extremely well on the stock markets, and since most people in life, and I think in stock markets as well, are very short-term focused. They want to avoid short-term pain and get short-term gains. So when almost everyone wants to buy certain stocks in the markets, it is obvious that rest of these spaces tend to become more value. And if you are seeking value, if you participate in that part, then you become a contra investor. So contra is an outcome of seeking value, but seeking value is the key. And I'll give you 2-3 examples here. Around 99-2000, the IT stocks were trading at 300-400 multiples. And everyone agreed, even I agreed, that they will continue to grow for many, many years, which indeed they did. But it is just that more of that growth was discounted than the real growth. And so they were great businesses, growing businesses, but bad investments. And since everyone was buying IT and nothing but IT, almost everything else became so cheap, it is hard to explain. You could have bought BPCL in 2000 for just the value of the LPG cylinders. You could have bought Ashok Leyland for less than the working capital on the balance sheet. So that was one great example. And these businesses which grew slower, but they delivered far higher returns, because if you buy something at 2 or 3p and if it goes to 15p, it is a 5 or 6 bagger. Around 2008, just the opposite happened. This was one time when quality was at a discount. So around 2008, you could buy the consumer companies, the pharma companies, the automobile companies in single digit or low double digit multiples. And we used to own Glaxo Consumer, they make Horlicks, at 12p. I bought it at 18 and I saw it fall to 12p. And people used to tell me, look, Horlicks is had only by sick or by old people. There is no future to this business. Because that time, everyone wanted to buy only the infrastructure, the power, the real estate companies, because they were doing well. So I think I have seen this time and again that the definition of quality changes, and what is in going up tends to get overvalued. But I must say that sometimes in the last few years, like you mentioned, corporate banks, we have been overweight. It can test your patience, because when a business is in pain, it is cheap. And you are buying it in the hope that that pain will go away one day, and that business is strong enough to survive that period of pain. And so this SR Steel case, it took almost 3 years to resolve. And we were hoping, given the IBC deadlines, that that resolution will take place much earlier. And that is why value investing can become difficult at times, because something in the environment changes and the pain period gets extended. But the key is to buy a strong business so that it is able to endure that period of pain. And you should of course be able to endure that pain. And because in the end, if your assessment of value is right, no matter how long it takes, the value does unfold, and the investment gives you the returns for the entire holding period.
So if I open to the floor right now, the first question would be, great example on Ashok Leyland, great example on Glaxo, but ab kya sasta lagta hai? So before I open it to floor, why don't you answer it?
See, I'll give you an answer which, you track our portfolio, so what a person thinks is, he likes it most, that's the biggest overweights and underweights, but let me answer that more specifically. See, I think, this is my opinion and many people disagree with me. I think the public sector companies are, to my mind, misunderstood by the markets. And there are sectors in which public sector is at a disadvantage, like the service industry. And there are sectors where public sector has a significant advantage, which are resource-rich areas like mining, where you have mines which have been given to you 20, 30, 50, 100 years back, where you have huge economies of scale, or companies or sectors which are very capital intensive, let's say oil or power, or where faith is involved, let's say public banks. So when PMC happens, you will never find a situation like this in a public bank. So ability to collect large amounts of money at low interest rates is a very strong comparative advantage for some of these banks. So I find, because of the frequent divestment by the governments, and particularly through ETFs in the last few years, this persistent supply, I think, has made these companies very cheap. I think many of these companies, especially in the mining, the oil and gas, some of the strong banks, the power sector, they are very sustainable businesses. And they are very, very cheap. And you can figure that out by just looking at price to book or the dividend yields on these companies. Most people don't like it, because if you have bought these companies in last 2, 3, 5 years, you have not done well at all. So they have caused immense pain. But I think they are sustainable businesses. They are trading below their intrinsic values. And what gives me hope is the shift in government strategy towards strategic divestment. So if in future, if that becomes the main route for divesting these companies, one, it will tell us the real value of these companies, what a strategic investor is willing to pay. And hopefully it will also reduce the frequent supply of these stocks in the market.
I'll again hit the pause button here. We'll be taking questions in 2-3 minutes. Get your questions ready. I'm coming to you, sir, but in 2-3 minutes. Lots of hands will come up, Prashant, so be better ready. Just one question on this entire way how markets have moved. Is buy and hold dead, or buy and hold will never be dead?
See, I think buy and hold, how do I answer this? I think clearly investing delivers far more returns than trading. And I don't think there is any denying that fact. If someone has to be exceptionally talented as a trader to make money, and unless you have it in you, I think investing is a far more secure and predictable way of making money, long-term investing. That means buy and hold. But it also means that there are two assumptions underlying, or two things you need to be careful about. One is you must buy sustainable businesses. You must not overpay. If you bought tech in 99 and you held it for 10 years, it was not a good decision. The day you realize that mistake in 2001, you should have corrected. If you held pharma 4 years back, it was very expensive, and you can see what pain is there. So I think first is you must buy right, and buy right means a reasonable quality business and at not an expensive price. And you hold it as long as you think it offers you reasonable value. As long as your exposure to that stock does not go up beyond what your risk management would indicate. or as long as you don't have something materially better. So if you look at our portfolio turnover rates, they are clearly below averages, much below averages, but they vary sometimes, most of the time between 2 to 5 years.
Okay, last question, then I promise I'm coming to the floor. Let's divide broadly India into three parts. First, where you have evergreen good growth, financial sectors, private banks, their growth, insurance, the growth is very strong. It's 10, 15, 25, that's the only debate. Second part where because of stress or distress, valuations have become up and down, like PSU banks, corporate banks. And third, businesses which you can catch them early, which can become big, like NBFCs or what happened to, let's say, TMT in 1990. So we know that you like PSU banks in bracket 2. What do you like in bracket 1, which is compounders, and what do you like in bracket 3, where businesses are young and they can become big?
So I think a better way to describe my view on banks would be I have liked corporate banks, both in public and private, and both are equally large with us. And simply because they were in pain, their liability franchise was very strong, and the balance asset side was in pain, and you thought that it will become correct, and some of these banks have actually done quite well now. So I think, identifying the third is always a challenge.
That's I'm asking you.
IT was a fairly obvious one in late 90s, and infra growth was there, but it was unsustainable. And today I am not able to find any piece in the economy which will grow extremely rapidly. But I do feel that capex and manufacturing will grow faster than consumption. But yes, there are sectors like airlines, there are sectors like organized retail, which could grow fast. But fast growth alone is not enough for the markets. The moment you say this business is growing at 30% for next 10 years, you must ask, are you the only one who knows that? Or the whole market knows that? So chances are everyone in the market knows that. And when quality companies are growing in a sustained way, chances are everyone knows that. And so then the next question you have to ask is your growth estimate higher than others? Or will you think growth will sustain longer than what others think or what markets are discounting? So growth investing is very tempting, but most often it pays less than value investing. And because people simply extrapolate the high growth rates of the last few years for very, very long periods into the future. And in 2000, I will give you a good example. There were many reports by consulting firms which were saying that this IT industry will become so large, $100 billion or something in the next 5 or 8 years. And it is only recently that that industry crossed 100 billion IT services. So we were 10 years late. Now the challenge with that was that if that growth rate slowed down, you simply lost a lot of money. So that is why it is not as simple as just buying a business which will continue to grow. Markets made the same mistake in pharmaceuticals. If you look at last 3-4 years, the stocks are down 70%, 60%. Why? Because the growth rate prior to 2014 or 15 in pharma was extrapolated indefinitely virtually. And that's how they were good companies, but they turned out to be not so good investments.
Okay. Okay, let's open the floor now. Sir.
Yeah, Prashant, this is Himanshu Gupta from Fuzzy Logics. You mentioned that the indexes are market cap weighted and therefore certain sectors because of overvaluation can dominate the index. So do you think there is a place for indexes weighted by, let's say, P by B ratio or dividends?
See, I think this is not a question for me to answer, and it is for the regulators or for the exchanges to decide, and I'm sure they know this. This has been debated, but in the end, there is a belief in the market forces, and I think there are lots of merits in having size-based, market cap-based indices as well. So I don't think I have a clear view on this, but I think on balance, but see, think of it this way, what's wrong with having a market cap based index? As long as you know that this part of the market is overvalued. and you have the ability to bet against it. In a way, it gives you an opportunity to do better than the markets.
So you're outsmarting the index by...
Yes, yeah, I mean, that's one way of creating alpha. If you did not own technology in 2000 and the markets were 50%, it gave you a massive opportunity to generate huge amounts of alpha.
Okay, yes, ma'am.
Thank you.
Let the lady ask the question. As it is Indian women complain, men are not chivalrous in India. So.
Hello, sir. I'm Sonali Sonpal from Millennium Ma'am, Kolkata. As you mentioned that a lot of industries from China would be coming to India. So in that case, which sector do you feel, that they find scope here? Like, is it agrochemical or electronic, or it is metal, which would like to come to India?
See, it is the global companies who are present, who have their supply chains in China, and these companies have to come. And when they come to India, India being a very large market, they will make both for India and for the world. I think areas which which have reasonable labor inputs would be obviously preferred, because something where the labor input is extremely low, India does not have a cost advantage, because a company would put up facilities where it is cheapest to manufacture. So I think we have to look for industries either where you have proximity to raw material. India has lots of agri-based raw materials. All the metal ores are there in India. So I think those industries could come. India is a very large market for consumer electronics. So there you may make even for India, because India itself is 15% of the world's population. So over time it will become a very large market. So I think that list, what came in BS, they said 323 companies, but I am sure one fine day that list will be known to us and we will know which companies are coming to India. But I think the first attempt could be in consumer electronics. But please remember, that means little to us, because these will be unlisted plants. And it is basically what mobile handsets or LCDs we are importing, they will be made here. And they will create jobs here instead of creating jobs outside.
Thank you.
It's a real pleasure to have you all on this panel. And we're going to start with, this $5 trillion number is a great number. And it's not a question of whether it's doable or not doable, at least I'm sure in my mind and surely in everybody's mind here. But I think that there are two pieces to this, and my two comments, and I'd like to get that started to get this panel going. So the first one is, I don't think there's any dispute about the fact that government, from a larger perspective, has done a lot of things over the last few years in terms of reforms. You look at telecom, you look at infrastructure, the spending, you look at every element, financial services reform. A lot of things have already been done by the government to a large extent. It is not that the transmission is where there's a blockage to some extent. And the second point is, of course, I am in the camp that disputes the statement that has been made today by ex-Governor Rangarajan, saying that 5 trillion is out of the question by 2025. I actually have a different viewpoint of it, and I'd like to get your thoughts on that. So with that, I'd like to just get, Nilesh, if you can start with, what do you see are the impediments to this? And what is it that you think that we should be looking at as a country, as a nation? What are the 2 or 3 key points? Are we missing something here? How do we get this demand process going in the economy?
So there are a couple of things which we could do. One, we have the 3rd largest stock of coal in our country, and yet we spend $22 billion in import of coal. And extracting coal, one can even do with bare hands. Now, what do we have to do to ensure that our $22 billion import of coal is reduced and our coal which is lying either above or below the ground is utilized? Second, as Indians, while the official numbers are many, we spend a lot of money on travel abroad. 2.2 crore Indians travel abroad, and we get about 1 crore foreigners to visit us, of which 40 lakhs are Bangladeshi. Clearly, we are spending far more money abroad. Now, could we encourage Indians to travel in India rather than traveling abroad? That, in my opinion, will save us about $15–20 billion. Third, we are perennial importer of gold. In last 8 years alone, we have imported $245 billion of gold. And the total foreign portfolio investment in equity and debt put together is $145 billion. So we are a patient who is admitted in ICU, but who insists on giving blood donation and then wants to blame doctor that my health has not improved. The day Indians realize that we can't afford to give blood donation, that $35 billion will be left in the country. Our trade deficit with China is running at $58 billion officially, and if you add Hawala, probably it is $65 billion. It's more than what America has with China as a percentage of GDP. The day we Indians realize that be Indian, buy Indian, told by Mahatma Gandhi is even valid today, hopefully our problem will be sorted out. I can keep on going on and on in variety of items where we are spending beyond what is necessary. There are certain items which we have to import from China, but when Amba Mata Murti comes from made in China, when Ganesh Murti comes from made in China, when Kanjivaram silk sari comes from made in China, then as a nation we should reflect. So I think we have to go back to the basics in terms of first sorting out issues like coal imports, gold imports, electronic imports, travel spending, education spending, and trade deficit with China. If we can manage that, automatically that will aid to growth.
So what in essence you are saying is that there is an inherent flaw in our trade agreement systems that we have put in place, or that we have in place, because at the end of the day you're not going to be able to stop demand, because a lot of it is demand oriented. As Indians go global and they start looking at a more holistic way of life, they are going to travel. So I don't think you can stop Indians from traveling. That is my read on it. But can you facilitate an environment where Indians consider traveling within India a lot more than they consider going abroad? Yes, because why is it that having a wedding in Goa is more expensive than having a wedding in Bangkok today, for example? You know, I mean, it's really it's a slap on our face, frankly, because the inherent transaction cost for somebody to have a wedding, simple thing. I mean, it could be it's not necessarily that weddings have to be very extravagant or whatever, but regardless of what the size of the wedding or the level of the wedding is, but still people consider going abroad sometimes more than often than to do it here. So I agree with you on that point, but I think that it's inherent flaw in the trade formatting system that we have within countries, like what we are right now doing with RCEP, for example. So Vaibhav, you have any points on this?
Yeah, of course. So while there are excellent points made by Nilesh Bhai, a couple of insights which I think have happened in the last 5 years, and which has changed the basic character of a business, in the sense that we've always been attuned to doing business in a particular way, before GST had come, or formalization had started to kick in. And we also all have to understand that the aggregate demand was because of formal economy, as well as a lot of stuff from an informal economy as well. Now, after the sea change in terms of the kind of reforms which are being implemented by the government, obviously, changing habit, overnight is not going to be easy, right? And over a period of time, you will see that more formalization kicks in. larger efficiency would also kick in from an economic perspective. So my take is basically that we are in that kind of transit period where doing business in a particular way earlier is now getting transformed to a new kind of environment where you have to, where formalization is the key, where you have to abide by rules and regulation, you have to pay taxes, you have to be pretty transparent in terms of your business dealings. And that is where this whole shift is creating that temporary kind of slack in kind of economy. And add to that is basically we had, our real interest rates, which were like the highest in the world kind of stuff in a year back, and liquidity being generally deficit in the economy. So I think a lot of this is getting corrected. Yes, we are in transit, will take some period of time, but my sense is basically it's just a matter of time where we'll start probably seeing that kind of recovery coming back to the aggregate demand as well and to the industry then.
But what can we do to actually accelerate that process? That's the key piece, because we are where we are, right? At the end of the day.
Yeah.
So I think what are the 2 or 3 things that you think that we need to do? Because we seem to be, what you said correctly, that we seem to be stuck in this transition mode.
So let me give you, one statistic. If you see in last 3 years or 4 years, and be with me because it's a little complex, is that the incremental direct tax to an incremental absolute GDP has risen from whopping 4.5% to 11%, okay, in the last 3 years. What it means is basically if you have, earlier there was an X amount of disposable income, is now getting, in incremental tax, which you are, paying it to the government. While you are doing formalization, it's perfectly fine. But my sense is basically to just balance out your formalization, you need to increase the disposable income in the hands of a consumer. What would I mean by that is basically that you may probably want to rationalize the tax rates on the income tax front. To give that kind of disposable income in the hands of the consumer. Because you cannot only focus on industry in the hope that demand at some point in time will probably come, right? You have to do both simultaneously where your balance between an industry and a consumer is pretty much there. Currently, if you see from all the policy perspective, there is huge focus on the supply side, rightly so. But at the same time, you will need to have that kind of demand focus or get that aggregate demand into picture as well. And that's where I say that you need to increase that disposable income in the hands of the consumer.
Understood. Adhika?
Yeah, I think there are a couple of arguments here. Like you rightly started off with the 5 trillion bit. I think it's good to know how many countries are actually above 5 trillion mark right now. There are just about 2-3 countries there. Of course, as and when we get to 5 trillion, they might be a bit high, about 4-5, not that many. So we are in fact looking at a very small group of countries that have gotten that big. And with our kind of population, our per capita GDP, which is also, I think, more important than the nominal figure, also will increase over time. So whether we get there in 5 or 10, I think we are surely headed that way. In terms of what would be what would get us there, if I were to look at the past 10 to 15 years of growth, you would see that while the real sectors, you talk about investment or you talk about agriculture or manufacturing, they have either declined or been more sideways. One of the sectors that has done very well is the financial services. So in some ways, that is also symbolic of the leverage in the sense that because of credit and not that much because of real growth, that we have seen lagged increase in growth. And now when that cycle is turning, we see the real fall showing in terms of where the industry has not been doing too well, and now we've finally got the consumption cycle as well slowing down. So how do we get around it? I would think that it would be really going back to basics. One is that too much of consumption argument is concentrated on the higher tier. That argument needs to come down to mean that the policies that we have, which have rightly already been initiated, many of them in the I think the past 5-6 years, which is to concentrate on education, concentrate on electricity, connectivity, on sanitation. So I think those will have more pronounced because you're now not looking at just selling cars, but you're also looking at providing basic goods, which over time improve health and then also helps in your consumption side. So while that is happening, I think for businesses, I think like Mr. Jain just mentioned in the previous session, with excess capacity, they don't have impetus to invest more. To use their existing capacity, they need visibility on growth, visibility on consumption. So I think consumption will be the first place to start, because based on consumption coming back, businesses will have more impetus to go ahead and invest. And for consumption to come back, I think in the very short term, I think it's fairly well known now that in the come February budget, you're going to see some announcements where I think consumption, at least short-term demand will make a comeback. And that I think over time will sustain. And as we do this alongside moving down the cycle in terms of consumption, not just concentrating on the upper tier, but also managing to get trap demand down the cycle, that I think it will be more beneficial for the real economies, agriculture as well as industry.
Excellent. Salil?
See, I think I'll take it from the point that you started, that 5 trillion, in the controversial statement that it will happen or not. I think it's very clear. It's not a question of whether it will happen. It will happen at what speed and how quickly does it happen, and what gets us there. I think this is a great opportunity for us to correct certain structural imbalances which are staring us in our face. For example, the agri portion of our GDP is by and large about 16%. The labor that goes into agri is about 49%. The manufacturing part of our GDP may be about 30 odd percent. The labor that goes into it is somewhat balanced, say 24%. And the services part, which is the big part of our GDP, which is the balance 54%, is done by the 27% balanced labor. And therefore, there is clear disconnect that in terms of, ability to pay, is strong in the service sector, but also concentrated in cities rather than small towns and villages. On the agri side, wherein we've got 49% of our labor contributing 16% of our GDP, and we are reasonably okay placed in terms of agri business in India, in the sense that it's self-sustaining by and large, except for a few disparities here and there. And there's productivity which is going to increase in agri, which makes more pressure point on the agricultural labor, which is half the Indian population. So we need to find ways wherein the service and the manufacturing pieces go deeper into Bharat rather than stay put in, metro India in some manner. And the enablers for all of that over a period of time have already been achieved. What are the enablers? You need electricity. We already have electricity in every village. At least the reach is there, the density is not. You need roads. A fantastic amount of spends have gone into road infrastructure, so we can reach into the villages and the small towns. Digital India, you got full connectivity, we are already there. Now it's a question of, maybe skilling people over there, systematically creating specific opportunities for labor in smaller villages, not to be incentivized to go to the larger cities, but getting better quality of life, better opportunities in that space. And do we have enablers for that? Additionally, we have lots and lots of them. I'll touch upon just one of them. I think somebody, Nilesh Bhai mentioned tourism. India gets about 1.5% of global tourism in terms of number of flows, number of people who come into India as percentage of global tourists. Why is India not a stronger tourist destination? Why does the tourist destination have to be only specific cities or large towns? India has enough cultural history, thousands of years of history, enough icons around the place, enough opportunities to create specific localized tourism opportunities. What it means is that the moment there is, let's say, tourist infra coming into place, clearly there is a service business which comes along it, there's logistics around it, the labor in the farm can be used for a whole lot of purposes to serve the same tourist population. The tourist need not be a global tourist. It can be the metro tourist going into the smaller towns, which again means that income movement happens from the larger cities into the small towns and the villages. People get skilled. The disparities start reducing quite a bit. And all of these are straight enablers in terms of growth. for us. So then it's not going to be a question of, whether 5 trillion comes or not. I think we can go on and on. There are enough enablers on this. I think one other point that I would like to touch upon is, the mindset. There is a mindset on, is profitability the right thing, or are we doing something wrong in terms of, profits? And so I think that mindset should, reduce a bit, clearly. Profitability enhances ability of the country to create opportunity for a large majority of the people. So like I'll give you one example on the, the telecom sector in India, which has gone through a lot of pain point in the current context. And it's a sector, if you look back for the last 20 years, it's created digital India, but the sector is languishing today. Or power. Power has created electricity, reach into the India, but the sector is languishing today. A little bit of policy rethink might potentially make a big difference for some of these sectors, which is, auction versus revenue share. Telecom benefited when we went revenue share route. There were questions around, whether it's licenses given to the right people, this, that, and so on. But the moment we get into revenue share rather than pure auctioning as a policy, it just unleashes great competitive spirit in corporates, which means sectors become profitable, which means that they have the ability to redeploy, which means, again, all of these opportunities can be easily exploited. And then 5 trillion is not going to be a question asked. It's how soon do we get there, and what's the next frontier after 5 trillion? I think that's how it will come out.
Yeah, but your point about tourism and also Nilesh's point, I think if you look at it, frankly, I think a lot of it has to do with the fact that today, it's not that India, from a government standpoint, government has not been encouraging tourism. In fact, tourism hotels were made into an infrastructure investment. So a lot of things have happened from that perspective. I think, is it the bureaucracy that is that is creating these shackles that we have to, because, at the end of the day, if you look at it, the PMO is doing everything possible to try and reduce the bureaucracy. However, that is not getting transmissioned across the country. So if you look at it, if you have a focus on building tourism inside the country for Indians, then you also have to develop to that extent the infrastructure surrounding it, making sure the licensing process of establishing a hotel or restaurants or any of those kinds of this thing around, whether it's religious sites, historical sites, all that is a much more, so ease of doing business in India. Do you see that as something that we need to focus on? Because we've done a lot, we've come a long way. In the last 5-7 years, I think that ease of doing business has substantially improved. I mean, we were in the pits, but still today we are not that far ahead as we would like to see us being there. Would that help this? Because, as Nilesh pointed out, about 3 key points, which is coal. He talked about a very, very basic, pure power is a very, very critical piece. We are importing instead of, being actually a net exporter. We have the ability to actually provide ourselves with that oil, with that coal. The second piece was the gold piece. And the third one was about tourism. So, Vaibhav, you talked about the transmission. It's just taking more time, but making sure that there's improvement on the direct access front. And then, Radhika, you mentioned about the whole process with consumption, how to enable consumption in society and how to bring it down to the masses, to the mass level. And then finally, you talked about the fact that there are so many different things that have already happened, but how do you connect this whole divide between urban India and Bharat? I think that is where we seem to be, even though a lot has happened, a lot is in progress, but we're not able to get that going, because how do you create that impetus and demand from a consumption standpoint in Bharat, not just in urban India to that extent? And why should there be a divide between the two? And like you said, maybe we take 50 cities which have a population of more than 1 million people, and then focus on that as a core, just like we have done with the airport. So just like the smart cities, those kinds of things. So Nilesh, what do you have? What do you think?
So I'll give you 2 examples which shows how India should take it forward. One was we launched or hosted Commonwealth Games. and there were enough controversy around it. But there was a date by which the games had to begin. And the whole resources of the government, the contractors, the private parties, the citizens came together to achieve that. If it meant building world-class Delhi airport in record time, we build it. If it meant building Delhi metro rail, we build it. If it meant launching stadiums which are of global quality, we did it. So if there is a time-bound delivery, then as a nation, we figure out a way. So what we achieved during Commonwealth Games by building metros, by building stadiums, by improving Delhi's infrastructure, by building world-class airport, benefit of that is visible in Delhi economy today. Can we replicate Commonwealth Games model across everywhere? Can Mumbai Metro also have a deadline by which it has to be finished? So that's one example. The second example, which I have personally witnessed and many of in this room might would have witnessed, is how Mundra got developed. Yes. It was a desert, arid place, not much income. Most of the residents and citizens in Mundra around were actually coming to Mumbai for jobs, for development. And then one entrepreneur decided to build a world-class port over there. It started slowly, but eventually it expanded to become India's largest port. And today, when you travel in Mundra, you see development, you see growth, you see opportunity. And my own brother-in-law, who was born and brought up in Mumbai and was working in financial services, have migrated from Mumbai to Gandhidham because he wants to become a clearing and forwarding agent in Mundra. Now, this may be an odd example of a Mumbaikar going to settle down in Mundra, but today Mundra is as cosmopolitan as Mumbai. And certainly people of Mundra are no longer coming to Mumbai in as much quantum as before. Now, these are the two prime examples of how we can create growth and development in the country. We have to replicate many more Commonwealth Games. We have to create many more Mundras.
Excellent point, I think. Vaibhav?
Yeah, so I'll continue on that kind of reform bit, and also will allude to what Salil also mentioned about skill development, which I think is extremely important. One thing is basically in the last 5 years, as I mentioned, there has been huge number of reforms, right, including GST, bankruptcy, RERA, etc. My sense is basically, apart from a couple of others, which is probably on the land and the labor side, I think we are through with the larger reform kind of agenda. But what is extremely important is basically that you then have to now get into granular aspect of making business easy, as you rightly mentioned, right, which is called ease of business, right? Making rules, making regulations, which are far easier and business friendly, right? I think as a business, when we also go into, applying for different structures or different licenses, we do face huge amount of, impediments in terms of, there are some rules which are not actually viable, right? So a dedicated industry, sorting out the, a core group of, particular industry sorting out those kind of nitty-gritty issues would, tremendously help doing that kind of stuff. Add to it, when we spoke about rural economy, right? We need to understand that, that there is huge amount of skill development which is needed. To elevate everyone to the new economy kind of stuff. When US is talking about, artificial intelligence and machine learning, how many of us as Indians would have some amount of exposure to kind of, those kind of new technologies? We are far away from there, right? So we need a broad scale skill development to happen. That will itself create huge amount of opportunities and bridge the so-called inequality between a rural and urban divide. So a lot of resources, I think, needs to be deployed for uplifting the kind of rural population so that they can create opportunities for themselves as an entrepreneur, which I think there is no dearth of that kind of spirit in India.
Thank you.
I might just go off a slight tangent here.
Please.
But remaining with,
the
theme.
Absolutely.
With the theme. I think digitization and technology, I think, is also helping bridge this gap between first tier, second tier, and third tier. I have a couple of examples. So I think the first thing that you're seeing technology do is give rise to startups, right? So you've got a very thriving startup here. I think the interesting bit is that beyond the unicorns and beyond the ones who are aggregators, there are many second and third tier startups who are concentrating on building social links. So for example, agri-based, there are about 400 plus agri-tech focused startups. So they are looking at last mile connectivity, how can they better predict the weather for the farmers or make sure that the supplies get there on time. And it's a relatively small, it's about 200, 300 million size market, but that is something which will help build the base for bridging the gap where your social causes also turn into a business enterprise. And I think that's one thing that is catching on very fast. That's number one. I think on the other side is also resources, right? So, of course, at different points in the year, we talk about different resource problems. In the starting of the year right now in Delhi, of course, it's the air quality that is being discussed about a lot. About 4-5 months back, we were talking about water and how important water availability is, particularly when rains were very patchy. There were heavy rains, but it didn't really help in terms of catchment. So I think that's the other part where I see a gap that can be filled, particularly from the, I think the angle I would like to draw here is that water as a resource constraint is important to look at because for companies, it is right now, it's like a business continuity process, right? If it's shortage, then you're going to have problems. But this is also a business opportunity for conservation, water harvesting. You've also gone against startups who are trying to build or create water out of thin air. So these are some of the businesses, I think, which are thriving in-house in India, which I think will gain momentum over time. So right now, again, we are looking at a lot of the bigger startups. We're comparing usually with the WeWorks of the world or the Ubers of the world. But there's a lot of second-tier work that is happening and which helps us build either the resource gap or is helping us build like the sector-specific gap. And I think that's where, and there was an event that I was at last month, and it was interesting that we had a venture capitalist in the panel, and he brought up a very interesting point. So he said whatever ideas are being brought to him now, he actually asked one question to the business, the person who's proposing. He says, which part of India is your idea going to serve, right? Is it going to serve tier 1? So he has about 4 tiers. He's only interested in looking at tier 3 and 4. If it is serving that part of the population, then I would go ahead and support your idea. So again, I mean, a bit away from what the scope of discussion was, but my idea is that there are sufficient catalysts in the system which I think can continue to build the.
No, it's not away from the system, I'll tell you, because, I spent quite a bit of my time in New York, as you all know. So, today in the United States, the way people think, whether it's Bill Gates, whether very wealthy people or even college kids, if they want to create an impact, so they say, God created a country called India, which is where you can create real impact. So the whole world wants to look at creating impact in a country, in our country. And it's not that there is a dearth of people in our country who are not concerned about this, but there is a huge opportunity. So it's a very, very relevant. And so maybe that's where the next few future HDFC banks, whether to put an analogy, or the Axis banks of the world that came out of India, or Kotak Bank that came out of the world from India in the 80s and 90s, over the last 25 years that we've seen. So where will that come from? I mean, I think that's really impact. It could come from the world of impact because, it could be social sustainability. It could be environmental changes. I mean, so, and as Nilesh very appropriately talked about a vision that one person had in totally arid, barren land, and convert it into one of the world's most state-of-the-class, art-class ports today. So I think that there are opportunities there to build something. I think it's a very valid conversation, so thank you. Salil?
Sanjay, your question was more into, as you said, limitations, is bureaucracy a hassle and this and then so on. And I heard that in the initial part of the sessions today to say, even capital is there, but people are not deploying it. I think I'm an investment banker, so I look at the positive aspect of it rather than the negative aspect of it. We are sitting on an extraordinary opportunity. Extraordinary opportunity. The world's capital is available at our doorsteps at the least price points for a fairly long period of time, ready and desperate to deploy, and for us to use. I'll give you an example today. The best of Canadian funds are picking up ready Indian assets in the form of REITs or InvITs at a great price points for them. But at the same time unleashes capital in India for risk investment. One sale of an asset gives enough capital, whether it goes to an Indian promoter or to the government doesn't matter, but there's capital unleashed in India for investment. And there's the whole private equity domain globally. There's enough capital in private equity is wanting to invest in growth opportunities in India. Me and Vaibhav do this for a living on the private equity side, that, all of that is running after opportunities. It's for us to just ensure that we are channelizing and getting those opportunities, going after the right opportunities. We are very clear that, a bulk of India's growth will come out of, this distributed opportunity exploitation which could happen in India across the length and breadth of the country, across sectors. I mentioned tourism, manufacturing itself is so huge in the Indian context. Using local strengths for manufacturing. Nilesh brought out the core point. We are sitting on coal, we are not using coal. We are sitting on a whole lot of farm produce today, which can be utilized for a whole lot of other purposes. For example, let's say India can be extraordinarily big on specialty chemicals. Specialty chemicals is all about, using organic capabilities in the Indian context and overlaying a level of R&D and research on top of that, and ensuring that products are used either in the Indian context where India has the consuming category or explored globally. We've done this time and again, so let's not get it wrong that we've not done this before. We'll touch upon something which happened 25 years back. There was this blue revolution, which was aquaculture. India was among the earlier entrants in that. There were some mishaps which happened. The mishaps are not as important as the fact that we in aquaculture, we converted a general traditional fishing capabilities into an extraordinary aqua business. We added value add on top of that and are today also an important producer for the supply to the globe of processed shrimps and so on. So we've done that in the past. We did that in garments. So we've used local capabilities to build a sustainable business which can last us for a long period of time. There are 10 other areas which will take us there, which then means that the economy thrives, the value gets distributed across. Once the value gets distributed across, the spending power goes to the entire India rather than to a concentrated few. The spending power itself results in a much more sustained growth. And we already have the infra overlays in any case. So we are quite excited. I don't think we should be worried about, stumbling blocks. Nilesh hit the point on the back that, if you got to set it, you put a timeline, it'll get done. Commonwealth Games, classic example. Set a timeline, it'll get done.
No, you're absolutely right. I think Nilesh's point is very, very valid. There are very, very well-established companies that have got into infrastructure business in this country that went in the right direction, thinking about the nation, but unfortunately got stuck, whether because of those payment delays or for whatever reasons, or time delays in terms of project completion, and have now almost on the verge of bankruptcy. So we've seen that time and again. But the good news is, to me, is the fact that we have a few very positive thinking bankers on this panel. So, because I think, and that has to translate into actual lending in the marketplace, because, as you all know, that we have a situation today where bankers are relatively more averse to lending and getting that transmission flowing in the marketplace. And it could be because of the fact that there is a wide gap in terms of private investment thought process. It's a mental thought process because as earlier Prashant had also mentioned, that there is a lot of supply already, so why should we create new supply in the marketplace? But I think it's a question of how do you get that supply transmission into the economy to create that impetus of demand. So on that note, I'm going to open it up for questions, if 2 or 3 questions, if somebody has any questions of the panel. Please. I think you had a question, please. Please go ahead. Sure. You're next.
I just want to understand which industry would lead us to the 5 trillion, that dream that we have in our mind, maybe in next 5 years or 10 years. Can any of the panelists can suggest which industry would lead in from the front? Like we did extremely good job in terms of IT, what we were in 1990, I think. Someone can help us to understand which industry will drive it?
Well, it's a very good question, but I must start with that first, and I should say that it's not going to be just one specific industry because there's so much work going across the board. I think it could be innovation, new businesses, it could be a lot, but let me start with the panel. Nilesh, do you have anything?
If $5 trillion GDP is Mr. Modi's target, then it's difficult to achieve. If it becomes yours and my target too, we will achieve it in 2025.
Absolutely. Very true. Please, Vaibhav.
So just, addressing your question is basically which industry? To be very honest, there is ample opportunity for every industry. What is more important is basically, we take the learnings of last 5 years, use the kind of global knowledge on ESG, which is environment, social, and governance, to create sustainable businesses, right? Those companies who would take care of minority shareholders, take care of their customers, their employees, and takes all the kind of stakeholders together, for an overall profitable, environment. I think those are the companies we will do, or industries will do much better.
Sure. Again, I think I will, I don't think there's one specific industry, but the few that I see that we deal, some of the business practitioners that we deal with, I think what is important is not only the industry that will do well, I think we'll have to have an industry that has the best benefit for the country as well. So I think it has to be a manufacturing capability that we need to build on. I think innovation, digitalization, automation, all those are extremely good, and I think that's going to permeate across industries. But again, if that becomes our primary focus, it will not carry the kind of benefits we need, which is basically more jobs and better disposable income. So I think I would lay my bets still with the manufacturing base. And among manufacturing, what are, the trends that we at least see, I see in the region has been, especially electronics has been one very, very important industry. I think at this point we are a net importer. We are just beginning. I think we have got some good FDI names who are coming now and establishing their businesses here and trying to not only sell domestically but also looking to sell outside. So I think electronics would be one. And also we need to recognize where we are in the value chain. Are we targeting the low-cost manufacturing? Then that defines a certain kind of electronics manufacturing. Are we in the mid-tier, which means that we move up and we talk more about boards, and motherboards, those kind of things, or we do the high-tech ones, which is again to do with more precision engineering. I think that would be an electronics, precision engineering, automation coming into manufacturing would be my bet for the region. And that is somewhere that we have not joined the race as yet, but we are now, I think in the past 1.5 years, if I were to just look at the trade numbers, for example, I can see some green shoots because you've got more, again, foreign capital that's coming in, which is helping to give that catalyst. And I hope that will move the needle for us.
Absolutely agree. Salil, you have any?
Yeah, we've covered quite a few. Anything which just, uses our strengths to the best possible level, which means that, our strengths are, we are a well-educated country. So your engineering capabilities and so on come into play. So any sectors like that will be a big driver. We have a lot of natural resources, and we can do value add on the natural resources and exports based on that. So food exports, processed food exports and the likes will become big drivers. We have I talked about tourism. We have a heritage and a culture and a history, which we can intelligently use it for getting our external income streams much stronger through the tourism of the route. I mean, there's no end to it. You can get value out of waste. We generate a lot of waste. Waste management can become a huge business in India. I mean, there's just no end to the amount of industries. It's just, marry this with the fact that whatever we set up, if it is, strong on return ratios, it's strong on capital efficiency, it's globally competitive, there's no reason why it should not be there.
I totally agree. And I think that, please, you have another question here.
Thank you. Nilesh and Salil, you gave example of Commonwealth Games, where we delivered not as part of structured process, but because our backside was on fire. So my question to Radhika, do you think that as an economist, is that the best way to deliver?
I think deadlines are the best motivation. I think we know that from our own cases, and we know that if any of us who have kids, we know that closer to the exams we study the hardest, right? So it is not a wrong thing, I think, to have deadlines, very hard deadlines. I think it's good because most of the time, I think I will use even the IBC for an example, right? So now we have the bankruptcy code. Last year we had very hard deadlines on it. There was pain, there was a lot of resistance, after which the deadlines were eased. And now you're seeing that some of the stuck projects are taking beyond years to get eased, or to get out of the system. So I wouldn't think it's a wrong thing to do. Certainly it depends on the industry cycle as well. And on infrastructure particularly, if we don't put it, I think what happens with infrastructure projects is that a bulk of the time goes away in the feasibility study, where then you have to acquire land. So once you have a deadline, all the other systems also have to fall into place. So you can't just merely have a deadline and not have the enablers in place. So for example, now if we go with the idea that, okay, we're going to get more FDI in, ease of doing business ranking is good, but it's just one of the ranks. And again, it's concentrated on the main 2 cities. It is not a reflection of what's happening across the board. So I think a good part there would be to say, if a company says, I want to invest, it expresses interest to a particular state,